All right, we are good to go.
Okay, everyone. So welcome back. I just want to kind of recap what we've done so far over the first two sessions. In the first session, we talked about filing information and requirements. That had to do with what we were collecting from information we needed to collect from each client and how that would be used to determine things like whether or not they have to file a return and what their filing status will be. And then the next session, we talked about dependent tests, and we went through my way of teaching dependent tests. Incidentally, people that haven't seen that yet, would encourage you, even though it's pretty simplistic for those with experience, would encourage you to look it over. It's a different way to look at dependency tests, and it might really help. And then also we did an overview of the Form 1040, and we're using the new Form 1040, just trying to get used to it because it looks different than it did prior to 2018. And then we also did a review of the calculations, how all the calculations go together in a Form 1040. And then we went through a bunch of filing basics, just taking a look at a W-2 and taking a look at a few things that were important. Okay, so that's kind of an overview. Most of that for Lisa and Sheila, who have some experience, it'll probably be pretty basic. Still would encourage you to review the chapters. And by the way, what I just went through covered your chapters 1 through 3 in the passkey, so units 1 through 3. So today we're going to go through what is units 4 through 5 in your reading. Okay, so 4 through 5. And so everyone that's trying to catch up, just read units 1 through 5. Again, a lot of it's review for several of you. Okay, so what I'm going to do is call up what I need, because the first thing I want to do, give me just a second, I'm actually going to push out, oops, that's not what I meant to do. Hold on a second, I clicked the wrong thing. I'm actually going to push out to you guys yet another document that I'd encourage you just to save. It's something you can look at later and even use now. So I got to get to it. Got to drill back into this part of it. And realize, too, all of these things that I'm sending out to you are going to be available on the website as well. And in fact, I'm going to send out 2 documents right now. I'm going to ask you to pick up both of those and save them because it'll help you. So the first one says 04B pre-tax explained. The second one says 04A federal income or not. We're going to be using both of those today. So if you can, save those and print out the federal income or not at some point, even if you don't do it today. It's not that critical today, okay? So what I'm going to do is I want to go through a PowerPoint that explains pre-tax and post-tax. This is a confusing concept for a lot of people, and yet when we're going into a section where we're going to discuss income. And to discuss income, you got to have an idea what we're talking about when we say, oh, that's before, pre-tax or post-tax. So I developed this believing that this will probably help with that. So pre-tax, post-tax, what does all this mean when we're talking about it? Because we're going to revisit it over and over and over again throughout this course, this concept. Here's the key. You want to focus, pre-tax and post-tax focuses on the timing of a payroll deduction. Can somebody just speaking up tell me what I mean when I say payroll deduction?
The federal taxes that come out of your paycheck when you get paid.
And the Oregon deductions, yeah.
Yeah, and the Oregon. It's everything. You're absolutely right. It has to do with federal income tax, Social Security tax, Medicare tax. It also includes other taxes, though. I mean, excuse me, not other, and it does include Oregon tax and so on. But it also includes other deductions. What other kinds of deductions might come out?
Insurance.
Insurance, 401k, things like that, where you're paying part of it out of your pocket, out of your payroll each month. That's exactly right. So when we're talking pre and post tax, we're saying focus on the timing of the payroll deduction. That's what this is all about. So you'll see what I mean here. You have and this is a timeline, if you will. You have a payroll deduction, then taxes are withheld, and then you have another payroll deduction. Now that seems weird, but that's the difference. So you have there's a time when some payroll deductions are made here, then the taxes are withheld, and then other payroll deductions are made here. So we'll walk through each of those. The payroll deduction that's made here on the first line is pre-tax. That's because it comes before the taxes being withheld by the employer. That's why it's pre-tax. And then the payroll deductions that happen after the taxes are withheld by the employer are called post-tax. Now, there is an important tax distinction for these. Those that are pre-tax helps you now, meaning you're going to get a tax break now because it's going to bring down the amount of income they're withholding taxes on. It helps you now, but you end up usually paying taxes on that at some point later. Post-tax is exactly the opposite. You've already paid taxes on all of your income, so it's going to help you later, but it's not going to give you any kind of tax break now. Okay, so let's look at an example here. And I got to move my little bar you guys can't see so I can see it. There we go. All right, so we're going to talk about a pre-tax, which helps you now. Pre-tax helps you now because it gives you less tax to pay now. All right. And we're going to go through an example there on the right in a minute. However, you pay taxes later when you withdraw it. So we're going to use an example of a 401k. It gives you a deduction now from your taxes, but you end up paying for it when you end up paying the taxes on it when you take the 401k out. So let's look at an actual number example. Let's say you got $1,000 pay. That's your pay for this, say, a 2-week period of time. Okay. Now, let's say you're having a 401k deduction of $100 each paycheck. So that's a pre-tax deduction, meaning it's going to come out before taxes are withheld. So $1,000 minus the $100 401k deduction leaves you with $900. So that is the amount, the $900 in this example is the amount they're going to actually base the tax on. So let's say, and these numbers are not right. If you were to go to pay actual taxes, these are not going to be correct numbers, but it's just to make the point. So let's say you, on $900, have to pay $125 of taxes on that. So 900 minus the 125 of actual federal income taxes, Social Security, Medicare, all of that come out, and what's left over is $775. Well, because you don't have any other deductions after that, that's your actual take-home pay. That's how much you make. See, this pre-tax helps you now because it gave you less tax to pay. If this had been $1,000 here, as you'll see in the next example, you would have paid more taxes here. So let's look at the next example. We're going to focus now on a post-tax deduction, a payroll deduction that happens after taxes are withheld. You pay taxes on all of your income now, but it's going to help you later because you will not pay taxes on it when you withdraw it. For example, a Roth IRA isn't one example, and that's what we're going to use here. So how would this work? Well, same starting point. Let's say you had $1,000 of pay for the period, but you have no pre-tax deductions. So 1,000 minus 0 is 1,000. So you're getting taxed on the full amount of your income now. Now notice the amount of taxes withheld are 150. Do you remember in the last example? I'm going to back up a screen. In the last example, it was only 125 because you only had $900 of income they were taxing you on. Now going back to this example, now you've got a full $1,000 you're getting taxed on, so you're paying more tax. So you can see you're getting taxed on everything now. So 1,000 minus 150 leaves you with 850. Now let's say rather than the 401k that we did in the previous example, you're doing a Roth IRA deduction of $100. 850 minus 100 leaves you with $750 of take-home pay. Now, why does this help you? Because a post-tax deduction means you're going to get a tax break later when you get the benefit of getting that money back. So when you pull out this Roth IRA, say 20 years later, you're not going to pay taxes on it because you already paid taxes when you put the money into it. Okay.
Plus you'd be in a lower tax bracket.
I'm sorry, say that again.
Plus you'd be in a lower tax bracket.
You might be. I mean, truthfully, that all depends on what other kinds of income you might have at the time. But yeah, all things being equal, you're correct. So let's look at another post-tax example. It's the same thing. It still helps. You pay all your taxes on all your income now, but it helps you later because you will not pay. And this is an example of sick pay when you get sick pay income. So $1,000 pay minus no pre-tax deduction, $1,000 of tax, you're paying $150, so you have $850 left over. But let's say you're paying sick pay premium deduction, and you're doing it post-tax, means you've already been taxed on the money that you're using to pay this. $850 minus 80 leaves you with $770 take-home pay. Well, how does that help you? Well, if you end up if you get sick and end up drawing money out of this, guess what? Because it's post-tax, you're not going to pay taxes on that income. So that's how that works. And that's really it. So before I kind of jump out of this, I want to give you guys a chance to interact with this material. First of all, any questions about it or any discussion you want to have that I didn't think to bring up? And again, you can always either just talk outright or throw it up in chat. Nothing? Makes sense? Okay.
Yep,
Okay.
makes sense.
All right. Excellent. All right. So the next thing we're going to look at, I want, and I'm going to put this up here just so you can see it, but we're not going to work with it here. This is the other item that I pushed out to you a little bit ago. I call it federal income or not. The reason I've made this is we're about to go into a section where we're going to talk about all sorts of different kinds of income. And some income is going to be taxed by the IRS, and some income is not going to be taxed by the IRS. And I do want to share this now. For the enrolled agent course, we're rarely going to mention Oregon law because you don't need Oregon law to pass the enrolled agent exam. On occasion, I might mention something about the state, just to help you make sense out of something. But for the most part, we're just going to be focusing just on federal. So with the IRS, there are certain things that they will tax and certain things that they won't tax. And I have this 3-page sheet here of a list of what they will tax and what they won't. And I do my best to correspond them. For example, we haven't got there yet, but for example, military pay is in the will tax column, but there's also a military pay over here. There's a few exceptions to it. So I do try to correspond those across the way. So if you see something on the right, it probably corresponds to something on the left, okay? The reason this is here is I'm not going to be teaching off of this, but I'd highly encourage you to print this out and keep it with you over the next several sessions, because as we go through, you'll see which column it falls in, and as we go through other material, you'll see that this can help you kind of summarize everything we're talking about, okay? So it's just a reference point. That's all this is for. Okay, so what I need to do is I need to bring up another PowerPoint. I'll get to it in a second because we're going to start talking about employee compensation. And all of these PowerPoints are being posted on the website for you guys to download if you want to. So we're just waiting for this to come up. Okay. So we're talking about employee compensation, what's going to be taxable, what's not taxable. So first of all, we want to kind of learn about the W-2. Okay. W-2 reports the earned income of an employee that's received from the employer. We all kind of know that. And if a taxpayer works for more than one employer, he's gonna or she's gonna receive a W-2 from each employer. Okay. Employers must get that W-2 to their employees by January 31st of the following year. Okay. So, in other words, we just finished the 2018 tax season. The 2018 W-2s were supposed to be out by when?
January 31st.
Of which year?
Current year.
Right, the current year. Well, in 2019. So you're right. So that's when they were supposed to be out. Now, if for some reason a taxpayer does not receive their W-2 by February 15th of the current year, or in this example, 2019, they can use Form 4852. Look, don't memorize these form numbers. They're not that critical. What is important is to know what they mean. A Form 4852 is a substitute W-2. That's all we're talking about. Okay, so if a person doesn't have a W-2, they need to get it. If for some reason they absolutely cannot get that W-2, they need to document the attempts they made to get it, and then after February 15th, they can actually do a substitute W-2. Okay, so again, for testing purposes, do I want you to remember Form 4852? No. But do I want you to remember that after February 15th, you can do a substitute W-2? You bet. That's what I want you to remember.
Yes.
Okay. Now, W-2. There are 6 copies of a W-2. They're not color-coded the way we have here. This is just for learning purposes. Copy A is for the Social Security Administration. Copy 1 is for the city, state, and local tax department. And then copy D is in Delta. It stays with the employer. So those are the first 3. Should your employee ever have any of those copies? Excuse me, I said that wrong. Should your employee, in other words, your client, should your client ever have a copy of copy A, 1, or D?
No.
No, because each one of those are supposed to go, D is supposed to stay with the employer, and the other ones are supposed to go to some government. But employees should receive, oops, sorry guys, employees should receive copy B, and that if they're doing a physical tax return that they're mailing in, copy B would go with the federal return, copy C would be for the employee, and copy 2 would be for the state return. And give me just a second here. Ryan, how do I get a pointer? I'm trying to remember how to get a pointer on this.
Go to your bar.
Is it the annotate?
And annotate. And
Yeah.
you'll see what's the spotlight.
Okay, let me try that. Oh, wait a minute. I think I see a different kind of spotlight. There we go. Perfect. There. That's perfect. Thanks, Ryan. So here's the thing. When you're doing real life tax returns, if your client has any of these, that could be a sign that there may be fraud going on. Now, does that mean necessarily that there is fraud?
No.
No. And why do you think that is? Somebody else give it a shot. Why do you think that it might be fraud, but doesn't mean that there is fraud?
The employer just doesn't know what to do with
No,
it.
that's right. That's right. The employer just maybe made a mistake. And I have seen actually copy A on rare occasion. I've seen copy A. And in that case, I usually, out of courtesy, with the client's permission, I contact the employer and say, I think you've made a mistake here. And usually they're embarrassed that happened. So that can happen. But employees should receive the copy B for their federal, copy 2 for the state, and then copy C for their own. So that's all. Guess I have to take the annotate off to move.
Oh, it's moved to the next screen, yeah.
Yeah, okay. All right. Sorry, guys. But some of you don't know this, but I'm still learning some of these tools myself, as you can tell. So clear all drawings, and I guess I just click on that again, and that clears it. It's not clearing it there, Ryan.
What you want to do is just, no, you actually have to turn the annotate off.
I'm sorry, just say that again.
Uh,
Oh, there we go. No, I figured out how to do it. I just have to close that drawing tool. Okay, sorry guys, I'm learning too. Okay, so here's an example of a W-2. Okay, and you'll see. Here's the things I want you to see. Most W-2s look like this, but they can be in slightly different formats. But the boxes are going to still mean the same thing. Box 1 are for wages, tips, and other compensation. Box 2 corresponds to box 1. That's the federal income tax withheld based on the amount in box 1. How do they determine how much to withhold? That's based on the W-4 that the client fills out. A W-4 is that thing that you fill out saying how many withholdings you're going to claim, how many people on that you're putting down, how much you want withdrawn. That's how they determine it, and then your employer simply uses a chart to determine how much to withhold based on the information you put down. So now box 3 is for Social Security wages. These are wages that are subject to Social Security tax. And then box 4 corresponds with box 3. These are the actual Social Security taxes withheld based on that amount. Box 5 are for Medicare wages. Again, these are the wages that are subject to Medicare taxes. And the amount in box 6 corresponds with the amount in box 5. Okay? And now, why would this make a difference? Because as you can even see in this example, the amount in box 1 can be different than the amount in box 2 and or box 3 and or box 5. They can be different for reasons you might not completely understand. But let me give you one thing you will understand because we already talked about it. Remember pre and post tax? We said that if you get paid some money and get a pre-tax deduction for something like an IRA, you get to deduct it. So look at this. Box 12 is a place where they put a lot of information, and sometimes some of the information is telling you certain deductions that are happening. DOG, stands for IRA 401k deduction. How much did this person have withheld? It's telling you how much, $2,600. Well, this tells you why there's a difference. If I was to take $35,321.59 and subtract $2,600 even, I get the amount of taxable income, which is $32,721.59. Does that make sense, guys? We're now starting to tie together what we started with this. Okay, Noemi, I heard you say yes. Lisa, Sheila, what do you guys think? Does that kind of make sense what we're doing here?
Yes, sir.
Okay. Thank you for calling me sir. Haven't been called that since the military. And so that's what that is. But that's why that is. And that's why that's a pre-tax deduction. That's why Social Security wages are higher than actual taxable wages. Okay, down here in box, and I'm not going to go through every single box here. But down here in box 13, you can see that you have statutory employee box, retirement plan. And that's because of this 401k sick pay. If this is sick pay, it'll be marked there. And there's a reason for that, but we'll talk about it when we talk about sick pay. And then the Oregon, excuse me, I said Oregon, but your state, YS. By the way, in any of our material, if it says YS, it means your state. So just pretend Oregon. So there's Oregon withholding, the wages that are subject to tax, the amount of state income tax withheld, and so on. If you have local wages and withholding, it would be there. Okay?
Yes.
Okay. So items reported. The most common type of taxable compensation that you're going to run into is the W-2. And we like W-2s because they're simple. They are not complicated to deal with. And each box means something specific and goes somewhere specific on the tax return. That's awesome. There's other forms out there that are not so nice. You can have like something on some 1099s, on certain kinds of 1099s, or even worse, something called a Schedule K-1. you can have something in like box 10 that can mean 2 or 3 different things, and you just have to know the circumstances to know how to report it and what it means. So in addition to wages, employers use W-2s to report other kinds of compensation that are paid to an employee. Now, and we're going to talk about those in a minute. So this is what you do. Box 1 income, box 1 wages, or anything in box 1 gets reported on line 1 of the Form 1040. So this one, $32,721.59. Now, whenever you report something on a tax return, you always round it to the nearest whole dollar. So if something is under 50 cents, it gets rounded down. If it's 50 cents or higher, it gets rounded up. Okay, so $32,721.59 gets reported on box 1 and rounded to $32,722. Now, we talked about boxes 3 and box 3 and box 5. Box 3 is Social Security wages. Box 5 is Medicare wages. We're now introducing you to box 7, which are Social Security tips. What? Now, we have some experienced people on the call here. What are Social Security tips? What does that mean?
Those are tips that are subject to Social Security tax, usually like allocated tips that weren't reported by the employee.
Okay, you're basically right, Garrett. Just to clarify, because I think you threw something extra in there, box 8 is the allocated tips.
Okay.
But box 7 is actually the Social Security tips that are reported. Okay, so we'll talk about that in a minute. But you're right. The reason they're called Social Security tips is these are tips that need to be reported to the IRS that were not included up here, okay? So, I don't want to get too much into the tips because we're going to have a section on that, but just know that that's why it is. And why is it important? Because we're just dealing with Social Security. It's not going to add to everything.
Well, allocated tips is the tips the employer allocates to the employee if they didn't report something, correct?
That's right. Yes, that's right. Yeah,
okay.
Allocated.
That's I was getting them crossed up, I guess, because
no, that's
together.
exactly right.
Yeah,
that's exactly right.
Okay.
Okay, so now I already pointed out to you that boxes 2, 4, and 6. Box 2 corresponds with box 1. Box 4 with box 3. 6 with box 5. So box 2 is the federal income tax withheld. And that gets reported on Form 1040 on line 16. So again, and it gets rounded. $4,437.18 gets reported as $4,437 even on line 16. So if you have 2 W-2s, let's say one person had 2 different jobs during the year. You take box 2 from both W-2s. You add box 2 from W-2 number 1 and box 2 from W-2 number 2. You add them together, and that's what you report here. Okay? Now, let's talk about this again. Remember I said box 3 and box 4 are tied in with each other. Box 5 and box 7 are tied in with each other. Okay? So let's talk about that. These are your Social Security wages. Here's your Social Security tax withheld, and it's withheld at a specific percentage. You can always know what should have been in here by using this percentage. For 2018, this is 6.2% of the amounts in boxes. Well, it's actually boxes 3 and 7. Okay, so here's where I got to explain something that I haven't explained yet. We touched on it, Garrett, so Garrett introduced the topic for us. Whenever you have income in this amount, these are wages that were not reported by the employee to their employer. Excuse me, tips that were not reported. So let's say you have a waitress and she's required to report everything that's $20 or more during the year. During the month. She's required to report all of that. And anything she fails to report she does not report that's under $20 a month, or even what she fails to report that's over, she needs to put on her tax return, and it goes right here. And for Social Security wages, it's this amount plus this amount. Let me think about what I'm just saying here for a second, guys. Yeah, it's this amount plus this amount. So you add Social Security wages and Social Security tips together and multiply that by 6.2%. So let's do this. Does everyone have a calculator handy?
Yes.
Yep.
Okay, Sheila and,
Yes.
okay, excellent. Is everyone with us? It seems like I lost someone.
There we go. That comes out right.
I'm here.
Okay, you're there. Lisa, no, it's because I have a condensed, smaller version of the window and your name just jumped off the end. That's all.
Oh.
It's still there. I just want to
Okay.
make sure I didn't lose you. So this is what I want you to do. Will everyone add box 3 and box 7 together? And tell me what that amount is.
$16,855.
Okay.
Yep.
Now that doesn't really surprise anyone, does it? Notice that's the amount here. That's because that was their total compensation, and it was split up between. I'm afraid I have said something wrong and misled somebody. I think I said something incorrectly, and I need to correct myself. Okay. Wages are going to include all income that was paid by your employer plus all tips that were reported to the employer. Okay, so that's why it's this amount, the 14,666 plus the Social Security tips, the 2189. Okay, so that's why these are getting added together and multiplied here. So now take the 16,855 and multiply by 6.2%. So in other words, times 0.062. And what do you get?
1,045.
Oh, one.
0.01.
01. Yeah, technically. That's right. No, that's exactly right. So you can see how you're getting that. Okay. Now, there is a maximum limit, and this limit changes almost every year. The maximum limit for 2018 is $128,400. What that means is once your boxes 3 and 7, once all of that gets totaling more than that, they stop charging you Social Security for that year. So if you made $200,000, about $72,000 of that would not be subject to Social Security withholding, but it would be subject to regular income tax. Does that kind of make sense what I'm talking about there, guys?
Yes.
Yep.
Okay.
Yes.
Now, the big question comes on testing. Do you have to memorize these amounts?
No.
Probably not. What you should memorize is this amount, though. 6.2% is critical. And if you understand this and a few other numbers I'm going to give you over the next few sessions, it's also going to help you. It's going to, if you can memorize just a few amounts, percentages, it's actually going to help you make sense out of why some of the numbers are the way they are. And I'll teach it to you as we go along. But I need you to remember that Social Security wages are subject to 6.2%. Okay? Now let's talk about Medicare wages. Box 6 shows the amount of Medicare tax that the employer's withholding. That's that amount. And that is exactly 1.45% of the amount in box 5. So let's do the math again. Everybody, just prove it to ourselves. The Medicare wages are $16,855. Times 1.45% gives us what? And I know you can see it on the screen, but actually do it on your calculator. It helps to remember.
244.397.
Right, which of course would round to 244.40, which is how the employer would report that.
Right.
So, before we talk about this, I purposely took that last screen off. I don't want you to focus on this screen yet. Tell me, Social Security is what percentage?
6.2.
Okay.
6.2.
6.2. Medicare is subject to what percentage?
1.45.
1.45.
That's right. Excellent. Good job, guys. Okay, now on a W-2, let's go ahead and focus on the screen now. Now on a W-2, you have box 12, and box 12 can have numerous codes in it. We already looked at D. D stands for what? Does anyone remember?
401k.
401k. Look, do you really have to remember that? Probably not. In real life, though, you do kind of want to remember that one. That's one of the major ones you will see over and over and over again, okay? But you have several other codes. You have a code A. You have a code B. You have a code D, which we looked at. You have a code Q, which we haven't even talked about yet. You have a code V. You have DD. Look, we haven't talked about any of these. And it's not really important that you know what they are. I'm going to briefly tell you what a couple of them are because you're going to see them again, but we're going to talk about them later. But this is what I want you to know. Sometimes it means it's just giving you information. That's an example of DD. DD is actually for the Obamacare stuff. That's where the employer reports how much the employer paid out of the employer's pocket for medical insurance for this employee. Okay? And why? Because there's a certain amount where if they paid more than a certain amount, it's considered a Cadillac plan and they have to pay additional tax on it. There's sometimes it is telling you information about some money that was paid but withheld from the taxes. That's an example of Q. Q stands for when somebody is in the military and serves in a combat zone. They can have several thousands of dollars in there that was paid to them, but it's not going to show up in box 1. And why do you want that? Because sometimes you might want to use that information to calculate some credits. Okay.
Earned income tax credit, child tax credit.
Yeah, exactly. So that's a reason it's reported separately. And we'll talk about that in a little bit. There's also code D, which we talked about, the 401k. Why do they report that separately? Well, it helps you understand why there's a difference on the W-2 between like boxes 1 and box 3. But it also tells you some information that you might use this to calculate a deduction on your return or a credit on your return. So these are things that's the reason box 12 exists. Whether or not it applies depends on your client's specific situation. Okay? So, and I also want to stress there are many more codes than this. These are just some of the most highly used ones, and I only highlighted a couple of them.
That's a lot.
Yeah. So now box 14 is a catch-all box on a W-2. It's sort of where they report anything else that you might or should know, and it might or it might not have any effect on the tax return. For an example, this one is showing SDI. This is state disability insurance. That's what this is. Is that deductible? Might be, might not be. It depends on the circumstances. We're not going to get into it any more than that. Just know box 14 is something you should take a look at it and determine if there's anything in there that you should be including in the tax return. Okay? And then on the W-2, and this is just a blow up of it, we already said at the bottom of the W-2 is information about your state. You know, state income, state withholding, so on. Okay, so let's do a little bit of a knowledge check. Review, take a look at this W-2 and then try to answer the questions. Okay, so I'm going to have to jump around a little bit. I wish they'd done this on one page because you're going to need to look at the W-2. So what is the taxable compensation that needs to be reported from this W-2? What's the amount? So at least
10,000.
Yeah.
Yeah, basically.
Yeah, rounded is 10,000. That's exactly right. Okay. All right. So what was the next question? What's the amount of federal income tax withheld? So I want somebody to volunteer before you answer. Who wants to volunteer to answer this one that hasn't answered yet? Okay, Garrett, go ahead.
It's the $1,014.18.
And how would that be reported? Actually, what amount would actually be reported?
1,014.
That's exactly right. Perfect. Okay. And what is the amount of state income tax that was withheld? And who wants to answer this one? Sheila or Lisa? Who wants to jump in and do this one?
$500.
$500. Thank you, Lisa. Sorry, I'm jumping back and forth. Oops, and I just jumped right past that. And so, Sheila, can you answer this next one? How much local income tax was withheld on this? Yeah.
$100.
That's exactly right. There we go, $100. Perfect. Now, employees should receive all of the following copies of the Form W-2 except, so which one should they not have in their possession?
Copy D?
I understand which letter you said.
Was it D?
D as in
D.
dog?
D like dog.
D, and I couldn't tell if you said B or D,
I said
baby
D.
or dog. Yeah. No, and you're right. Good job. Which copy of the Form W-2 should be attached to the federal income tax when filing a paper return?
B as in boy.
B as in boy. Perfect. Now, Ben lost his W-2, so his employer faxed him a copy. I want you guys to read through these and then just let me know when you're ready. In fact, do you guys know how to raise your hands in the interactive mode?
No.
Okay. Ryan, are you with us?
Yes, I am.
Why don't you, can you, when I'm in control, can you still jump in and show something?
No, I can't.
Okay, well, then we're not going to deal with it right now.
Right.
It was just one way of doing it. When you click on participants, you can't see the screen that I just popped up, but if you click on your bar that says, and it says participants, you can raise a hand or you can click yes or no or something like that. Can you guys see that?
I see it. I saw
My
it.
bar disappeared.
Yeah, you've been having some problems with that,
Yeah.
haven't you, Lisa? Ryan's going to work with you after the session because we need to get you help with that. But for now, we're okay.
Oh,
We'll
there
work
we
around
go.
it.
Raise hand. Okay, I see.
Yeah, and that's all.
Okay.
But it's all good. Not to worry right now. So
Or you can
ignore
do
that.
this.
So what I want you to do, yeah, physically, but not everybody has their camera on, and that's fine. So this is what I want you to do. I want you to read through these answers, and then everybody, I'm going to give you about 30 seconds to read them through, and then I'm going to ask somebody to volunteer to give us the answer. Okay, 10 more seconds. Okay. So, who wants to volunteer for this answer? Just speak up. Just say, yes, I want to do it.
I'll do
No
it.
one?
I'll do it.
Okay, Garrett, what's the answer?
I say it's Ben must wait until after January 31st to file his return with the copy, but
Okay.
he'd have to fill that form 4852.
Okay, so
That may be
the
wrong,
date,
but that's my
yeah,
my,
that's
my,
okay.
my
No,
opinion.
that's okay. That's okay. You explained why. But keep in mind, we're saying when you can't get a copy of the return, that's when you can do a substitute W-2. And the date's wrong anyway. Remember what the date actually is? It's February.
15th. Yeah, February
15th,
15th.
right.
for that, yeah.
So this is wrong for two reasons, is because it's not February 15th. And second of all, we're talking, he has a copy of it. It's just not the original. Well, that's okay.
Okay.
Let me get back here. There we go. So Ben can file this using his copy. And that's the key. And by the way, that's exactly the reason, Garrett, they're asking this, is to point out that, to make that point. You can use a copy of a return. It doesn't matter. It can be faxed to you, it can be emailed to you, or you can have the original. All those are okay as long as he's got a copy of the return, because it's the information in it that's important.
You mean the W-2, not the return.
I apologize. Yes, the W-2. You're exactly right. So that's what's important. It's only if you can't get a copy of the W-2 or the original W-2, that's when you can consider doing a substitute W-2.
Okay.
Okay. So what is reported in box 14 of a W-2? State tax. Let's do this together. State taxable wages, yes or no, everyone?
No.
No.
No, you're correct. Federal taxable wages?
No.
Okay, where is state taxable wages reported on a W-2? Does anyone have one in front of them that they can remember what box number that is?
It's down by the,
Wait a minute. That's okay. Lisa, I see your note about you can't unmute, but you could type in your answers if you want, so that's fine.
17. Back 17.
Yeah. So, and then federal taxable wages are reported,
Box 2.
okay, and retirement account contributions. What box does that go in?
box 12.
12.
So, that leaves us with miscellaneous information such as the amount of union dues paid. And that's your answer right there. Now, what we just did there is a great way, demonstration of how to take a test. When you're going through something and maybe you're not sure of the answer, immediately start just eliminating the ones that you know are not the right answer. At least you're increasing your chances of a good guess. So you guys all knew that the first two absolutely weren't right because they have their own separate box. Okay?
Yes.
Okay, so Form W-2 Box 1. Okay, so Box 1 shows wages, tips, and other compensation. Which of the following is not included in Box 1? Lisa, could you give me your best guess? And it's okay to type it in. You could just say A, B, C, or D. That'll make it easier. Deferred compensation. That's exactly right. Good job, Lisa. Okay. Now, let's talk about incorrect information. How do you handle a situation where the W-2 has some errors on it? Well, if the error is just incorrect address, you know what? You may want to point it out to the employee so that it gets corrected, but you can still file the tax return. Just make sure to put the correct address on the Form 1040. That's all that really matters. Okay? But if they have an incorrect Social Security number, an incorrect name, or incorrect dollar amount, if they have an incorrect of any of those things, they need to go back to their employer and ask the employer to issue a corrected W-2. A corrected W-2 is called a Form W-2 or W-2C for corrected, and they can't file that return until that corrected W-2 comes in. That's unfortunate when that happens, but the reason is if you have a incorrect Social Security number on there, the wrong person might be getting credit for some of the taxes paid, for example. Okay. Obviously, if the dollar amount is wrong, I actually had this happen once. I had somebody came in and they were showing, I don't remember the exact amounts, but they were showing like something like $320,000 of income. And I was doing the return and I thought, well, great, this person's doing well this year. And so I put it in. And then when I started reviewing the tax return with them after I got it done, they said, what do you mean? I didn't have that much income. So we went back and took a look at the W-2. And sure enough, it was showing that. What had happened is just somebody had accidentally added an extra zero when they were entering it. And so we had to actually send her back because obviously she did not want to be in the highest tax bracket. So that's how you handle these things. Now, we mentioned this earlier. Sometimes a W-2 might not be correct because it's fraudulent. And you want to look out for possible clues that it might be fraudulent. Here's some things to consider. Let me get my pointer up here. I think this will help me do this with you. So here's one of them, a duplicate or incorrect copies. So in other words, remember we talked about if they have the wrong copy, that can be a sign that it might be fraud. Incomplete or altered entries, such as strikeouts, typovers, things like that. Look, in today's world, you rarely see any strikeouts or anything like that. In the old days, maybe when it was done by hand. But here's the thing, though. If they're following the rules and an error is made, they're supposed to destroy that one and just redo it. So if you have that might be careless mistakes. The client's name is spelled wrong or the zip code's wrong or something like that. Not computer generated. In other words, it's handwritten or typed or photocopied. But keep in mind, a small employer might be doing handwritten. That's why these are not always absolute proof that it's fraud. That's why you just check these things out. The name or social security number errors, that could be a sign of fraud. Missing social security or Medicare withholding, or the amounts are incorrect. How can you know if the amounts are incorrect with a quick glance at the W-2? Garrett, how can you know?
I can know if it's incorrect, the name.
No, the social security withholding and Medicare withholding. How can you know if it's incorrect?
Well, you go by your 6.2%,
There you
your
go.
1.45%.
That's right. That's right.
Yeah.
You know that because you look in box 3 for social security income and multiply that by what percentage, Lisa?
6.2. Sorry.
Oh, that's okay.
6.2%.
Good, Lisa. Thank you, Garrett. Sheila, how much is the Medicare withholding percentage?
1.4.
1.45. Okay.
Right.
Okay.
Sorry.
Yeah, it's okay. This is all about learning. We're fine. So 1.45%. So you can quickly check to see if those are right. And by the way, if it's rounded off by a few cents off, that's just their rounding, how their computer's doing it. Nothing to worry about there. If you have unusually high federal income tax withheld, why would that be a possible sign of fraud?
Because they're trying to get the earned income credit, or more of a refund back.
That's right. Exactly.
Right.
No, exactly. They're trying to get a higher amount of refund back, claiming that all these taxes were withheld when they weren't. Incidentally, does anybody here really think that would work?
No.
No, because the IRS gets a copy of this. They know how much was reported as withheld. So, rounded numbers. You round the numbers when you're reporting them on a tax return. You do not round them on a W-2. Those are supposed to be reported to the nearest cent. Okay, so rounded numbers can be a sign. Or missing required state amounts. Look, these are all just things to look for as you do a tax return and look at a W-2. Okay. Oops. Okay. I'm trying to get my computer to change. There we go. Now, as a tax preparer, you're required to exercise a thing called due diligence. Due diligence means you are required as a professional to check on certain things, ask certain questions, and document what you find out, and then keep some notes for the period of time that you're required to hold on to the documents, okay? That's due diligence. So if you suspect fraud, here's some things that you could do. If you suspect fraud on W-2, you can tell the taxpayer that you need to verify the information with the employer. Now, you can do that in real life. Be careful when you do that, because if you do that in real life, you want to talk with your client and you want to let them know that you just need to verify this. I would not say because you're suspecting fraud. Just tell them, hey, something's wrong here and I need to just consult briefly with the employer, make sure everything's okay. That's all you got to say. And then ask them if you can do it. Okay. Another thing is contact the employer to verify employment. If you're able to verify the W-2 is legitimate, go ahead and prepare the return. Just make sure to document what you've done. Hey, I called the employer. He said that he had a new bookkeeper that made a mistake on the person's, on the person's address, for example, or something like that. You just document it. Now, some W-2s also include a verification code, and that verification code is found in box 9. Now, not all W-2s have this. The verification code is a 16-digit code that includes letters and numbers, and if it's on the return, if it's on the W-2, you need to enter it into the return. Why does that exist? It's because the IRS is experimenting with this as a way to crack down on fraudulent, in other words, made up W-2s. So if they've assigned a number to that W-2, they won't let the return be filed until that's entered as part of the W-2. That's all. Okay, so let's do a little quiz here. And I'd like everyone to do it this way. Get onto your chat if you can, okay? Everybody try to get into their chat. And what I'm going to ask everyone to do is we're going to go through, ask the question, and then we're going to say the answer is A, B, C, or D, and everybody enter their answer. So first one, Marlene received her W-2 on January 23rd, and notice the address shown as her old address. What should Marlene do? A, B, C, or D? So everybody enter it into the chat. And Sheila, were you able to, you're still not able to get that, are you?
Correct.
Okay, that's all right. What do you think the answer is, Sheila?
B.
That's right, B. Tell me why that's the correct answer, Sheila.
Because that is the current address of record, and that's where the IRS would be sending the refund to.
Exactly right. So it's not critical that it's wrong on the W-2. As a good practice, everyone should always let their client know, though, if it's incorrect on the W-2, because it's possible the employer is sending the W-2 to the wrong address. So correcting it now will help them in the future. Pedro, so let's try a new one. And I'm just typing in new here. And I'm doing that so I can keep them separate. So Pedro is a paid preparer. His new client, Amy, gave him a W-2 that looks suspicious. Pedro's required to do what because he suspects fraud? A, B, C, or D? Go ahead and type it in. Lisa Mendigan. Okay, and Sheila, what's your answer?
A.
Yeah, exactly right. Exercise due diligence. Perfect. All right, let's do number 3. Which of the following is not an indication that a W-2 might be fraudulent? A, B, C, or D? And your answer, Sheila?
D.
B. It's not, or it is computer generated. Remember, handwritten, rounded numbers in lines that are corrected by hand or something like that, those are all indications it might be fraudulent. But
Okay.
just because it's computer generated, that's what we prefer, actually. Okay, so good enough for now. Let's move into another area. So by the way, those of you that are able to glance at or have already printed out that federal income or not handout that I gave you, that was the first thing on there was W-2 wages. So that's the first one. Now we're going into military wages, and you'll see that's listed on there next. So I'm just referring to that and showing you how you keep referring back to that 3-page handout. So the next one, military pay. Now, one thing before we actually talk about military pay, I want to make a general statement. Generally speaking, all income is taxable. As a general rule, there are just lots of exceptions where certain things might not be taxed. But keep in mind, illegal income is taxable. Interest income is taxable, which we haven't talked about. But generally speaking, just keep in mind, most things are going to be taxable. IRS doesn't let you get away with hardly anything. But let's talk specifics now. Military income. Now, military people receive different types of pay, and some types are going to be taxable and some are not. The types they list here are included in taxable income. So your basic pay, in other words, your standard pay. Any special pay you might receive for any kind of work that you do, it'll be special pay. It'll be added right into box 1 of your W-2 or their W-2. Bonuses, if they get like a re-enlistment bonus of $10,000, guess what? That $10,000 is going right into the box 2. It's all getting put in there. Incentive pay. Incentive pay is when they need people to go into specific areas of work. Like, for instance, they might be short on dentists in the military, so the military might offer any dentist willing to enlist for a period of like 6 years of special incentive pay, in addition usually to a bonus to enlist. So all of those are taxable. although all of these kinds are subject to federal income tax, only some of them are going to be subject to Social Security and Medicare tax. So keep in mind, when I say taxable, we're usually referring to federal income tax. So we can say something's not taxable, but it might or might not still be subject to Social Security and Medicare tax. And while this sounds really confusing, do keep in mind as you start working with it, it starts making more sense and easier to follow. And my cheat sheet should help you keep this straight too. The one I just sent out. So let's talk about allowances that some military people get. This is in addition to their pay, and they can receive an allowance or a reimbursement for expenses that they incur as a result of their service. These can be for like traveling. When I was in the military and I had to travel different places, when I was traveling, I actually got a travel expense. They called it a stipend, but it was a travel expense. Some people get a living expense because they have to live somewhere and there's no housing provided for them, so they're given X number of dollars to use to provide their own housing. Now, these kinds of payments are usually excluded from taxable income and also from Social Security and Medicare taxes. And that makes sense because these are in the nature of reimbursement. If I am in the military and I'm living someplace where there is no base and they give me a stipend of $1,000 a month to, pay for rent, they're not going to make me get taxed on that because that's just them trying to take care of my living expense. If they have me travel for training and they give me a stipend, they're making me basically pay from that stipend. In other words, they give me some money and I pay for it. They're not going to charge me for that because I'm doing it, so I'm paying that out so I can do my job. Okay, and so I'm not going to get taxed on federal income tax or Social Security or Medicare on that. Now these allowances, you'll see them on a military pay stub, and in military pay stub, they have their own fancy word for it. It's called leave and earning statement or an LES, but it's not going to appear on a W-2. So when you see a W-2, you're only going to see the taxable part, not the non-taxable part. But if questions ever come up and you're a little confused about what was there, what wasn't, that's where you might ask to see a leave and earning statement, and you'll be able to see what was actually given to them. And by the way, there is a note here, and this is a great note. On occasion, you will see, like I've seen military housing allowance put on inbox 14. It's there because there are times that you might want to use it to calculate. There are times that you need to calculate like support and things like that. There are certain things that you've got to calculate for doing a tax return that has nothing to do with taxable or not taxable income. And so you will see that sometimes in there. Just know if it's for any of these kinds of things, you don't get taxed on this. So now there's a thing called combat pay. Combat pay is when a person is serving in a combat zone, and IRS has special rules that say when you're in a combat zone, we're not going to tax you on that pay because you're in such a high risk environment. It's just a way to reward somebody. If they have combat pay, it's always going to be reported in box 12 and on the W-2, and it's going to have code Q. So it's going to have the code Q and then the amount that was excluded. So the amount they list there is not in box 1 of the W-2. And it'll also list, usually in box 14, the combat zone that they served in. And you need that because you have to put that on the tax return. You actually have to write it or print it on the tax return. Okay, so let's take a look at an example of a W-2. First of all, from the military, and I'm going to get my pointer up here again because it'll help. Notice this right there, DFAS, Department Finance and Accounting Service. It's always there. It's not always coming from the same location. There's a few different locations throughout the U.S. Where these can happen, where these payments get made out of. But it's always the Department of Finance and Accounting Service. In short, DFAS is a short. You may hear that a lot. So there's the wages that are taxable. This is the amount that goes on line 1 of the Form 1040, and that's what they're going to get taxed on, regular federal income tax. But let's jump down and show all the income that they're not getting taxed on. There's $12,525. BAH stands for basically basic allowance for housing. Housing allowance, in other words. That's what that is. So there's an example of a housing allowance. This is not part of this, as you can tell. And then you'll also notice that what else is not part of it? There's a Q. This person served in a combat zone, and the amount that was not included in their taxable income is $19,473.88. So that's not in here either. Okay, so there's two major things that are not in the taxable income. Now, Social Security tax is only based on part of this, but notice it's more than this, because some things, there's the amount for federal income tax. Here's the amount for Social Security and Medicare taxes. Okay, so you'll notice some things are going to be taxed by Social Security and Medicare, but not for federal income tax. And that's all we're pointing out. Now, do you have to know all the rules and when it's taxed, when it's not? Not for this, because it's already telling you. That's why I don't want to spend a lot of time. But if you were to start playing with these numbers right here, you'd get this number right there if you started playing with it. And I'll let you guys play with it sometime on your own. And by the way, these are available to you. These are actually available to you on the website, where you can download these presentations, not just the live presentation being recorded, but also this PowerPoint. And so you can play with this. Okay, so any questions about the W-2 from the military? I don't want to jump past this until you guys have a chance to process the information.
It seems pretty straightforward.
Okay, okay. Okay, good.
James, can we download the presentation later?
You can download the
After.
PowerPoint that you're looking at. Yes, and it's actually available on that website that we were talking about, that Ryan's going to get up and running. And I believe he's going to have it up probably before we even finish today.
Ah,
But
okay.
yes, it is available. So you can, all of these PowerPoints are going to be available online for you, as well as this interactive video. In other words, the web conference we're having here, the recorded web conference, is also going to be available. Does that answer your question?
Yes.
Okay. All right. So let me. Okay. Oops. So what we want to do, I'm sorry, I'm jumping around here. There we go. So just to show you, there's his taxable income is right there, and it goes on. Ignore that. I know this says box 7. That's because this is a 2017 return. I apparently forgot to switch it out to 2018, but it goes on the first line of the new Form 1040. That's all it does. It goes right there. That's all you really needed to see with that. Oh, one other thing too. Notice I said you have to write an Operation Enduring Freedom. There it is right there at the top of the tax return. Okay. Now let's talk about foreign country incomes. Now, military people that are serving outside the U.S. and members of their family may actually earn income from some other source. So let me give you an example. When I served in Germany with the Army years ago, I had some friends who's they were married, and their wives actually worked off base, just earning a little extra money. So they worked off base. And when they worked off base, they're earning foreign income, okay? And in some situations, these special rules apply to this income. And we'll deal with those later. I just kind of want you to be aware that you can earn foreign income that military people earn, and there may be special rules that apply because they're military. Okay? All right. So let's take a look at this. Richard received the W-2 shown. So how much of Richard's military pay is taxable? So take a look at that. And Lisa, I'm going to ask you to be the first one. Could you look at that and tell me how much is actually going to be taxed for federal income tax purposes?
Hold on, let me put my glasses back on.
Oh, I'm sorry. No problem.
Okay, so what's
So how much
federal
is
is going to be
yeah.
$6,137.
That's right. Rounded when you report it. You're exactly right. Perfect. Okay. So now Misty is serving in the military. Which pay type is not subject to income tax if none of the payments are for service in a combat zone? So in other words, we're saying all of these are, assuming they're not serving in a military combat zone, all of these are going to be taxable except which one? Who wants to take this one on?
Me,
Okay, Sheila?
housing allowance.
Exactly right. Good job. Housing allowance. Base pay is. Hostile fire pay is not the same thing as combat duty pay. You'd think it would be, but that's because you have to be in one of the zones that are considered combat. But a hostile fire pay is a situation where you may be under hostile fire, but not in a combat zone. Re-enlistment bonus is just a bonus. All bonuses are subject to income tax. Okay. Now, let's talk about some other kinds of employee pay. So far we've talked about W-2 income. Generally, that's taxable. We've talked about military pay income. Generally, that's taxable. There are just a couple of exceptions. And then now we're kind of moving into other employee pay that you can get. So what is this other employee pay? Well, obviously there's wages, but they can also receive compensation from their employers that are reported on a W-2 for things such as tip income. In other words, tips that have been reported to the employer. Prizes, awards, and bonuses. So you, those of you that are tax professionals have already worked for us know that you get to get a bonus for the work that you do. Well, that's taxable to you. So all those things are taxable. Sick pay. If you get sick or disability pay, it might or might not be taxable. Okay. And that depends on whether or not if you're the one that pays for it. I'm kind of getting ahead of myself here, but it'll help us. If you're the one paying for it or your employer's paying for it. So let me just quickly tell you, if you're paying for the disability pay, if you're paying for it pre-tax, okay, do you think will it be in your W-2 income if it's pre-tax and you're paying for it?
Shouldn't be.
That's right. It shouldn't be, because remember that pre and post tax, your income minus pre-tax gives you what's left over for taxes. So it's already not in there. Okay. Now, what if it's post-tax? Will it be in your taxable income?
No.
Let me ask that differently, because I think I may have confused you. If at post-tax, meaning you've already gotten taxes taken out of your income and then you paid for the disability pay premiums.
Okay.
So would that actually be showing up on your W-2 that as income? Yeah, it would be.
Yeah.
Remember post-tax? Do you remember that? Pre and post-tax that we started out with? That's why this is so critical. If you have money taken out, give me just a second. I think it might behoove us for me to try to find that. I think it would be a good idea. This is why I want to do this, and it helps us to do this. That's why I don't mind backing up for a second and covering that again. Can you see that one? Okay. Okay, it's big enough. So post-tax, meaning there's $1,000 of pay, nothing's taken out, so you have $1,000, and that's what you're paying taxes on. Anything you pay taxes on, this is the amount of income that shows up in the W-2, right there, okay? So post-tax means that deduction, let's say you had $100 taken out for, in fact, I think my next example is one of these. There it is, sick pay. This example, There's your sick pay premium deduction. So in fact, all of your income was subject to tax, and that means all of it's going to show up on the W-2. Because this is no different than if you didn't have it taken out of your pay, that as if you got all $1,000 minus taxes, that if you got it all and then you just wrote a check to this company yourself. That's the same thing. Does that kind of make sense what we're talking about here?
Yes.
Okay. So I hope that helps, because it is pretty important what we're talking about. Let me get this back up. Okay. So if you're the one that's paying sick pay and it's post-tax, it's going to be in your W-2 income. If your employer paid for it, it's not going to be in your W-2 income because your employer's paying for it as a benefit.
Yes.
Okay. And then fringe benefits. These are small things, and we'll talk about those. But those are basically some examples of stuff that are reported on your W-2. Okay? So let's talk about tip income. We touched on this earlier, and now we need to get into it a little bit deeper. First of all, tips received, any tips received, all tips received are taxable income. They've got to be reported on your return. You either report it by telling your employer about it so they can add it to your income and get it on your W-2, or any that you miss, you have to add in yourself. Okay, so let's talk about that. These can be tips that received in the form of cash, and that's what most people think of, or on a debit or credit card slips when you add it to, like I go to a restaurant and I add a tip by writing it in rather than leaving cash on the table. It can be from tip pooling or tip splitting arrangements where everybody working there is just throwing their tips together and then they divide it up. It can also be non-cash items. You don't see this very often, but if I have a maybe I have an extra ticket to a game or something, and I decide, hey, I'm gonna give this to my to my waitress because she did such a great job. I might hand her that ticket. Well, now that's income to her. The value of that ticket is income to her. So employees receiving tips must keep a tip diary or tip log. Everybody is supposed to keep one. How many people really do keep tip logs, do you think?
Not very many.
Not very many. On occasion, you actually have somebody that's quite good at it, but it's very, very rare. Tips totaling more than $20 in a month are required to be reported to the employer. So any employee who receives $20 or more in a 1 month period of time, the beginning of the month to the end of the month, is supposed to report it to the employer. And the employers are supposed to withhold Social Security and Medicare tax on the reported tips. So that's why we were saying that that the Social Security tips are really important. Remember box 7? It's really important that that's there because those are income that was reported that's part of what needs to be paid out to Social Security and Medicare, and the employer is supposed to actually be making sure to withhold Social Security and Medicare for that. Now, what happens if there's a month where you didn't report anything and the employer knows darn well you had to receive some tips? Well, he might start doing allocated tips to estimate the amount that was not reported. That's reported in box 8 of the W-2. Employers do not withhold Social Security and Medicare tax on allocated tips. So the employer is not withholding it. So employees have to pay them at the time they file the tax return. In other words, the amount that's in box 8, there's a special form that's filled out to calculate how much Social Security and Medicare you got to pay on that as well, in addition to your regular W-2 income. Okay. And so tips totaling less than $20 a month are taxable, but they do not require reporting to the employer. So in summary, tips under $20 do not have to be reported to the employer, but can be. But if you do that, you're going to have to add them in later. Tips reported that are more than $20 a month must be reported to the employer, and the employer must take out Social Security and Medicare tax on that. And then if there's a month where you didn't keep a record or didn't report it, your employer will likely be required to do allocated tips where he's estimating the tip amount you received. Incidentally, these are not good. Allocated tips usually tend to be higher than the actual tips, in some people's cases anyway. So allocated tips can really hurt somebody because there's no Social Security and Medicare taxes taken out. So if you have $10,000 of allocated tips for the year, they're going to end up paying how much for Social Security on that? What percentage?
$620.
Oh, you did the actual math. Yeah, you're right. In other words, what percentage? What I meant by that is the 6.2%.
Oh.
She did the actual math based on a number I threw out. So it took me a moment to catch that, but that's fine. So 6.2%. So that can add up really fast and affect somebody's refund. Okay, so let's use an illustration here. Let's first of all walk through this example. I'm going to get my pointer out so it's easier to for you guys to see it. Okay, come on now. Oh my gosh, hold on a second, guys. There we go. Okay, so let's look at January. This person did not keep track because they were too busy. What's going to happen for that month?
Allocated.
Allocated tips. The employer is going to allocate tips for that month. February, she kept track and knows she got $175. Was she supposed to report that?
Yes.
Yes. In March, she did not keep track because she was too busy. So Amanda, what's going to happen to that income? What's going to happen there? I'm sorry, I can't hear you.
He's going to allocate tips for that.
That's right. The employer is going to allocate tips for that month. So now in April, she received $15. Does she have to report that to the IRS?
No.
No, that's right. But she is going to have to include that on her income when she does her return. So May, $315. Does she report that to her employer?
Yes.
Yes. June, $290. Does she report that to her employer?
Yes.
Okay. July, she had $19. Does she report that? Is she required to report that to her employer?
No.
Nope, she's not required to, but she does have to add it in later. August, September, October, November, December, all of them are over $20. So all of those should have been reported to the employer.
Yes.
So how much? Somebody do the math for me. How much should have been reported to the employer? Can somebody do the math real fast?
You just flipped.
Sorry, guys. Yes, I did. My bad.
$21.89.
Yes. 2189.
What amount is in box 7 right there?
$21.89.
See, those are amounts that, yep, those are amounts that were actually reported to the employer. And you'll notice that if you were to add 2189 plus the amount in box 3, 14,666, what do you end up with?
1685. 855.
855. That's right. No, that's exactly right. Notice that's the amount in box 1. So you can see that that's what we're talking about. Box 3 plus box 7 added together is at times 6.2% will equal that. Okay. You see how this is fitting together? So the amount that was reported to the employer is actually subject to both federal income tax and is subject to Social Security and Medicare tax. So that's why we're doing this, but it had to be reported separately so we knew how much was reported to the employer. So far, so good?
Yes.
Yes.
Okay. And I really, guys, this can be very confusing. I'll be honest with you. It took me my first 2 years of doing taxes to start really getting my head around this. So don't feel embarrassed if you want to stop and ask a question about it. Okay. Okay. So now let's take a look at March, January and March. We said that allocated tips must be applied for those 2 months. How much allocated tips were applied for those 2 months?
1, 2, 2, 3.
And what box
1,
are
2,
you
2,
looking?
4.
Yeah, that's right. You're correct.
8.
What? Yeah, box
Box
8.
8.
So everybody look at box 8 and you'll see $1,223.75 just for 2 months. I'm not saying she didn't make that amount, but doesn't that seem awfully high for only 2 months?
Yes.
Yeah, that's the problem with allocated tips. This is why a person needs to keep their own log and really be reporting it to their employer every month. Incidentally, there is a way to we're not going to get into it other than for me to tell you this. If somebody, and by the way, I should say this has to be added in as additional income for purposes of figuring even more Social Security income. Okay. So in other words, this has to be subject to Social Security and Medicare as well. You can overcome this amount if your client brings to you and said, I didn't earn it for that time. I just forgot. I actually did keep track these 2 months. Let's say she said that. I did keep track for these 2 months. I just forgot to give them to my employer. So if she can show the log and add up the amount she actually received, you can use the log instead of this amount. Okay.
Isn't the allocated tip a certain percentage of the employer's gross profit?
Yeah, there's a calculation that the employer uses. I actually don't remember what that allocated tip is. Percentage. Because I don't do payroll taxes, meaning from the side of actually doing them for employers. I've done it, but I don't have enough experience to feel confident that I would remember the number correctly. But yes, you're right. There is a formula that they use. There is a certain amount of judgment they have in it, but there's a formula they basically use. Okay. So W-2 box 1 is $16,855. And I'm just going to jump back and forth. You can see W-2 box 1 is $16,855. Everyone can see that?
Mm-hmm.
Okay. So plus the amount of allocated tips in box 8, which is $1,224. So we know, like I said, you have to add that in. Then also you have to add this in, because this is also subject to federal income tax. What else is subject to federal income tax on this sheet that you can see here that's not already accounted for?
The tips that weren't reported.
That's right. Perfect. April and July, these are tips that were not reported. That totals up 34. So there's your other 34. So all of those get added together. And then Penny's total taxable income is $18,113, which is reported on Form 1040. So that's how that works. And I think the slide's a little messed up, so I apologize for that. But okay, let's do a knowledge check. Daniel is a hairstylist who receives tips from his customers. Each week, he faithfully reports all tips he receives to his employer. What boxes on Daniel's W-2 will include his reported tips? So what I want everyone to do is to type their answer in, A, B, C, or D. So the question is, which boxes will include his reported tips?
Can you flip back to the previous slide with the W-2 on it?
Sure. Does that help?
Yes.
Okay. And I may need to go back. Are you done? Is that okay? Well, I mean, because now other people are reading answers. So let me know if you need to see the W-2 again. It's okay. It's okay. We're getting all sorts of answers, but that's okay. Anyone else want to weigh in before I move on? Give you the answer? Okay. Here we go. Here's the answer. It's B, boxes 1, 5, and 7. So let's take a look at it, just so we can see the actual. Oops, I went too far. 1 are wages.
Mm,
5 are Medicare wages, and 7 are Social Security wages.
okay.
Yeah, so federal income tax wages, Medicare wages, and Social Security tip income wages. So that's what he will include in his reported tips. Those are the ones that will include his reported tips. Remember, so we're saying he reported them. Where do they come through at? Well, they show up as part of his federal income tax wages that is earned. They show up obviously as federal income, tip income earned, and it also shows up as Social Security wages. Okay, so 2, Alama, and if anybody knows how to pronounce that differently, let me know. But I'm going to say Alama works as a waitress in her uncle's restaurant. She has not reported any of her income, tip income, to him for the 3 months that she has worked there. When she receives her W-2 for the year, in what box will her uncle report the tips allocated to her?
8, box 8. I'm sorry.
That's
I have
okay.
to write.
That's okay. Everybody write it. Okay. Yeah. And you're right. You're right, Noemi. It's box 8. Box 8 are the allocated tips. Okay. So here's one of those situations where we're going to try to figure one of these out together. Okay. So Mabry received the monthly tip income that's shown. For each month she received $20 or more, she reported those tips. For each month she received less than $20, she did not report those tips. Her employer added her reported tips to the amounts in box 1 of her W-2. How much additional tip income will Mabry need to report? So we're just going to work with this for a minute. So first of all, what I would do to handle this, and we can work on this together. So I'm going to go to my annotation because it makes it a little easier for me to point out when I do that. Did she report this amount for January?
No.
No, she didn't because it was less than 20 during the month. Did she report February amount?
No.
No.
Okay. Did she report June amount?
No.
What
No.
other amounts did she not report?
September
September.
and October.
October.
Perfect. So what we need to do, we know that how much additional tip income will Mabry need to report? We know he needs to report all the amounts that were not reported. So add those together and tell me what the total is.
78.
Somebody's fast.
78.
Everybody agree with the amount?
Yes.
Okay.
Yes.
78. Good job, guys. Okay. All right. So it really is that straightforward. It's a little confusing just to keep straight which boxes go with which. But just remember, in box 7 of a W-2, that is an amount that was already reported. It's already part of your federal income tax and your Medicare. It just needs to get added with box 3 to determine how much Social Security income. Beyond that, the only other thing you're adding in is if there's an amount in box 8 for allocated tips, which you can overcome if your client has a tip income record, and any amounts that were not reported, you just add those in. Okay? All right. So far, so good. I want to just give us a chance to take a breather rather than me charging forward some more. How's this going? How's this? Is this kind of all making sense and working out?
Yes.
Yes.
All
Then
right, excellent.
it's a lot that I already knew. So.
Yeah, I know, and for a lot of you guys, it is. I'm teaching for those a lot that are basically brand new people, have not been introduced to this. So, but still, I want you to know, the first 3 years I was a preparer, I kept going through certain portions of the basic tax preparation course again, because I felt like repeating the basics was really going to help me. And I think that served me invaluably over the last 15 years because you get the basics, it's going to help you with everything else. So.
Yeah, last year was my first year, and that tax book thing that we all had. Every day I would go over that just so that I knew what was going on.
Right. No, and that's great, Lisa. And so this is really good too. And plus, you're seeing some things you're familiar with, but as you stick with it, and even if you watch some of my presentation, like about dependents, you'll see that I teach some stuff a little differently than they do. And sometimes seeing it from a different perspective can help you really get it.
True.
So again,
Hey, James, can I interrupt for a moment?
absolutely.
Does everybody have their computer up where they can go to a different browser by chance?
Yeah.
Let's just go to a website. It is jhtax-oregon.com.
Ryan, do you want me to give you control so you could, do you want to take control so you could show them? I can always come back to this if that would help.
Give me 1 second. I'll just pop up here on this one.
I think that's what I'm going to do, guys. What I'm going to do is I'm going to give him control, because what he wants to do is actually show you the website that he's talking about. I think he just got it ready.
Let me go ahead and pop in here.
Do I need to stop sharing to give you control?
Yeah.
Okay. So, guys, I'm going to stop sharing for a minute. We'll come back to where I left off. Ryan's going to take over. So we're taking a breather to show you this website that he put together.
All right. You guys can still hear me, I assume, here?
Yes.
Okay.
As a matter of fact, Ryan, just a quick question for you. If you need a couple of minutes, this might be a good chance to let everybody have a 2 or 3 minute break. And
yeah, let's do that quick. Let's take just a couple minutes break, and I'll pull this up quick.
Okay. So everybody, let's say we'll be back in 3 minutes. Okay, just a quick break to grab something to drink and whatever else. Stretch your legs. I'll see you in 3 minutes. Okay.
And go ahead, James.
All right. I'm coming back to taking control here, and from current slide. So we're going to go a little bit longer here, and then we'll stop and take a bit of a break. There we go. Okay, so once again, I want to refer you back to that handout that I set out of federal income or not. Again, we're just working our way down the page. By the end of this session, we will have gone through all of page 1, just to let you know. So now we're going to talk about sick and disability pay. Employees who are sick or disabled might be eligible for special pay. Sick pay are for employees who become sick or are injured while they're away from work, and they're often able, if they have these benefits, able to receive pay or compensation during their recovery period before they return to work. So when an employee receives sick pay, it's usually going to be, not always, but almost always going to be reported on a W-2. That W-2 can come from one of two sources. It can come from the employer itself, or it can come from the insurance company that's handling the claim. It'll come from the employer when the employer is acting as their own insurance. In other words, they might say, hey, we're going to pay you 2 weeks worth of salary if you get sick. If that happens, it's the employer just reaching into his or her own pocket and paying that, okay? If it's coming from the insurance company, it's because the employer or someone paid premiums to an insurance company. Either way, it's going to look the same. When you get in there, you're going to have an amount in boxes 1, 3, and 5, and it's going to say in this case, third-party sick pay. That's telling you this is all sick pay. Okay, so that's how it's going to look, and sick pay is taxable. Now let's talk about disability pay. Now, when an employee, which is different, when an employee's sickness or injury is so serious that they're not able to return to work, they can start receiving their retirement early. Now, this is one of those exceptions to where if you start receiving, you haven't learned this yet, but normally you cannot start receiving any retirement from a 401k or a pension or anything like that. You can't start receiving it until after retirement age. This is one of the exceptions where you can and not be penalized for anything, but it's still going to be taxable. Okay, so these are reported. All types of retirement are reported on a 1099-R. But here's the difference. This looks like any other 1099-R, except the key is this code tells you it's for disability pay. Okay. In fact, here, this is a better picture of it. You can see code J. Okay. You can see the amounts here, because here's what's really happening. The amounts here are your regular pay. The amount here is your disability pay. That's what J is standing for. Okay. And yeah, let's just jump into this and then we'll go into this a little bit more. Jill is 42 and received a disability pension distribution. You know what? Let me stop. There's something that's not on here that they forgot to tell you. Here's what they forgot to tell you. If you're not of retirement age yet, but you're already getting disability pay. Okay, so this is disability pay from a pension. If you're getting a disability pay from a pension, it is going to be reported on box 1 of the Form 1040 as if you were earning it. Why is that? Because anybody who's disabled and not retirement age, disability is treated as if you were earning it. So you actually put it in box 1 rather than where you'd put retirement income, which is on a different line. So let me say this differently. On your W-2, you have one line for reporting earned income. You have a different line for reporting retirement income. But if you're receiving your retirement income early because you're disabled, but you're not of retirement age yet, you actually report it as if you earned it. That's all. And you can potentially get disability income reported on a W-2, which is what this is showing. Okay. All right. So now we're ready, I think. Jill, 42, received a disability pension disbursement of $15,726. The minimum retirement age for her employer is age 55. So first of all, is Jill of retirement age yet?
No.
But she is receiving a pension before she's of retirement age.
Right.
So how much is she going to report on Form 1040 line 1, which is the line for wages, tips, and other earned income?
15,726.
That's exactly right. Perfect. Good job. Okay. So what code in box 12 of a W-2 indicates that the taxpayer received non-taxable sick pay?
Code J.
Code J.
D.
I'm not sure who said something else. I didn't hear it, but the answer is code J, because again, I'm going to back up here just so you can see it. J, that's sick pay right there. This up here is earned income. So somebody got sick, but also got some pay from sick pay. Okay. That's all that's showing you, is there's some sick pay coming. And you notice what is not marked here, third-party sick pay.
Mm-hmm.
That's because the employer themselves back this up. If it was from a third party, it would have looked like this. Notice there's no code J here because it's a third-party sick pay and all of it's sick pay. Does that make sense, what's going on here?
Yeah.
Okay.
Yes.
It's a little bit weird, but it's just different situations. So it's the same thing, but remember, an employer, a third party can pay it if it's an insurance company, and this is how it'll get reported. If it's an employer paying it, it's going to look like this with a code J and the amount of regular income taxes and then the amount subject to sick pay. And then if you're getting disability pay, and I'm sorry they kind of did it in this order. It's a little confusing, I think, the way they presented this, but we're going to use it anyway. If it's disability pay from a pension or anything similar to a pension, it's going to be reported on a 1099-R, and you just report the income as taxable income, and you put it either on the normal retirement line of the Form 1040 if they're of retirement age, or if they're under retirement age, they report it as wages on line 1. Okay? All right, so hope that helped a little bit on that one. Now, Sam is an employee of Eastfield Manufacturing Association. Sam took time off from work to have surgery that he needed. Eastfield pays the premiums of the accident and health insurance policy. So in other words, the company's paying it for them. When Sam receives his sick pay, will it be taxable or non-taxable?
Taxable.
Non-taxable.
Okay. All right, I have a taxable and non-taxable. Who else wants to weigh in?
I think it's taxable.
Mm,
Okay. Why do you think it's taxable?
Because he's not paying it, the company's paying it.
You're right. That's exactly the reason why. That's
I was going to say phone a friend.
Yeah, so here's the no, here's the thing. Here's the thing, guys. IRS are going to allow people on their tax return to take tax deductions. That is a tax deduction. Those premiums are tax deductions to the company that's paying them. Do you think the IRS would give the company a tax break and then turn around and give you a tax break too? No. Do you see what I mean? They're not going to give a tax break to the company for paying the deductions and then turn around and let you get the money for free. That would be double dipping. The IRS would be allowing two tax breaks for the same thing. So they're making you pay. Now, what if Sam himself paid this with post-tax income? Meaning taxes are already taken out, and then just before he gets his paycheck, they take out the premium for him, and he's paying it himself in that situation. Would that be taxable when he gets his sick pay?
no.
No, it wouldn't. You're 100% right. Now, let me show you something. I'm going to back up a few pages here because I want to show you. That's why these can get confusing. This W-2, that's the situation. That's the situation here. Oops, not that one. My bad. I'm trying to get to the right one. That's the situation here. Notice there's a code J. Notice there's $20,163 that was paid to him. Why isn't that up here? We know it's taxable. I can tell you why, because he paid for this with post-tax dollars. The company did not pay for this. He paid for the insurance himself. So when he happened to need the insurance, he got the money tax-free. That's why he actually got paid this plus this, but this is the only amount that's getting taxed.
Would that be where you would get, where it would be shown if it were AFLAC in 12A?
AFLAC, no, AFLAC would be a third party. It would look more like this one. It would be
Okay.
a third party.
Got it.
See what I mean? So that would look different.
Right.
Yeah. Yeah, but that's why, and that's why I want to show it to you. It's a little bit confusing. It's really not that hard. What's confusing is just remember you got to look at a couple different boxes to get an idea what's going on.
Right.
So that'd be taxable to him, but because just what I think it was Lisa that said that it's because the company paid for it. So the company's getting a tax break on their end, and Sam has to pay for the income that he receives. Okay, so that's it with sick pay. It's pretty straightforward, actually, except for a few little nuances. Now let's talk about fringe benefits. These are benefits that include things such as, and this is not a complete list, health insurance. So, you know, your employer might pay all or part of your health insurance premiums. Child and dependent care assistance. Sometimes they will pay for part of child or dependent care, or they will actually provide it in some cases. Adoption assistance, educational assistance. Several companies that tend to hire young college-age people have educational assistance. One good example is Walmart. They're very well known for a fairly liberal educational assistance program to their employees, where they'll reimburse them up to a certain number, a certain amount for going to college. Group term life insurance, transportation, parking, and commuting assistance, other de minimis benefits. Look, some but not all of these are taxable. Okay. Now, again, on that sheet, federal income or not, I've kind of got these listed out to help you keep these straight, but let's briefly talk about them. First of all, let's talk about health insurance. Generally, health insurance is not taxable as a general rule. Many employers only pay a part of the plan's cost and the employee picks up the rest. So the employer might pay like 60% of the premiums every month and the employee has to pay the other 40%. The percentages can vary. Very few employers pay 100%, but there are some out there. There's a few out there that actually pay none of it, and it's all paid by the employee. Most of them they're both splitting it. The employer generally withholds pre-tax dollars from employees' pay to cover the employee's portion. So in other words, generally, most of the time, and I mean to the tune of 90+% of the time, if you have a client in front of you that gets health insurance, the employer's paying part of it, the employee's paying part of it, and the part paid by the employee is with his or her pre-tax dollars. Again, we're back to that pre-tax and post-tax thing. Pre-tax meaning those premiums are getting taken out before it's that the income is subject to taxes. That means that they're paying fewer taxes. So because it's pre-tax, they're not going to pay tax on the amount of premiums that comes out of the employee's pocket. How will you know if it's pre-tax? Well, if it's pre-tax, actually take that back. You won't know from this, but what you will know is that the employer's paying part of it, because if the employer's paying part of it, they have to report it on the W-2 box 12 with code DD, and they're going to put down the amount the employer paid. Now, in real life, in fact, even on any testing, you don't do anything with this information. That's informational only for the IRS. You don't do anything with that. You just know that they have health insurance, they accepted the health insurance, and that the employer is paying at least part of the, excuse me, paying at least part of the health insurance. To know whether or not somebody paid for it pre or post-tax dollars, you'd have to see one of their pay stubs. It will not be on a W-2, or you ask them. If in doubt, assume that it's pre-tax, because it probably is. Okay. Does that make sense on the health insurance? What's going on with that? And do you understand that pre-tax? I want to make sure that's still clear. Everyone confident with this?
Yeah, I'm confident.
Yes.
Okay. All right. All right. So we'll move on then. Now let's talk about child and dependent care assistance. Some employers help fund the cost of we'll just call it child care for short, for their employees, children, or other dependents. If they have paid some, if the employer has paid some of this, it's the amount they paid is going to show up in box 10 of the employee's W-2. Now, we skipped over that when I went through the W-2 because I wanted you really focusing on other boxes, but now's the time to pay attention to that. If that amount is in there, it's in there because when you go to calculate this thing that's called child and dependent care expenses, which is a credit that can be taken on a tax return. Have we discussed this yet? No, but when you go to calculate it, you need to know what that amount is, because that affects the calculation. So just know that that's all that is. So you calculate the child and dependent care expenses on Form 2441, and you need to know that amount because the amount in box 10 of the W-2, what the employer paid of those expenses, the employee does not get to take as part of their calculation, part of their deduction, if you will. Okay, I'm pausing just to give you a chance to ask questions if there are any. None? Okay. Good enough. All right. So let's talk about adoption assistance. Any amount that employer pays for adoption assistance will always be shown on the employee's W-2. It's going to be in box 12 again with the code T for adoption assistance. Look, there's a lot of rules that go with this, and we're not going to get into that. But just know this, adoption assistance is available. If there's an employer that pays this, it's going to get reported. And then the employee, when taking the adoption assistance expenses as a credit on the return, as a benefit, I should say, on the return, when they take that, they're going to have to do this form here, the form 8839, which is called a qualified adoption expenses. And they have to, again, account for what did not come out of their own pocket but was paid by the employer. That's why it's on there. And why is that? Because again, the IRS is not going to let you take a credit for something that that somebody else paid for. So in other words, if your company gives you, like a $5,000 of benefit assistance, you don't get to take credit for that because you didn't pay that $5,000. And that's the kind of information that they're trying to provide. Any questions about adoption assistance? Okay. Let's talk about educational assistance. This one you'll run into much more than you will adoption assistance. Employers can provide a certain amount each year to be used for the employee to use for tuitions and fees and books and, going to college. Now, this amount does not have to be included or reported on the employee's W-2. And that's because it's not going to be taxable to the employee. It is taxable to the employee, however, if the employer reimburses more than the qualified expenses. So let's say the employer, let's say Jane is an employee and she went to college and spent $2,000, but the employer, in fact, let's say she spent $1,980. Okay, so $1,980 is her expenses, but to make life easy, the employer just wrote her a $2,000 check, just to round it up. Well, the $1,980 is not going to be taxable to Jane, but the $20 extra she got will be. And that makes sense because she didn't actually use those to pay expenses. It's just going to be treated as income. Now, notice there is a limit here that I skipped over. This is the maximum amount that an employer can pay. So they can provide up to $5,250 per year for educational expenses. If they pay more than that, the amount more that they pay is not going to be tax deductible. So if they paid Jane $6,000, how much is Jane going to, and assume Jane spent $6,000. Let's say Jane spent $6,000 on education and they reimbursed her $6,000. How much can Jane deduct of that $6,000 as non-taxable income?
$5,250.
That's right, $5,250, $5,250. How much is she going to have to include in her income as taxable?
$750.
That's right, $750. The extra $750 she got that was above this amount. That's exactly right. And that's how educational assistance works. Okay. And again, this is all laid out in that federal income or not. And I keep referring back to that because we're going through a bunch of rules really fast, but they're fairly simple rules, but it's easy to get them mixed up because there's so many of them. That little cheat sheet I gave you there is going to help you keep it straight. So when you're actually studying, try to keep, what's taxable, what's not, use the cheat sheet and kind of memorize what's on the cheat sheet. That will help you much more than going through a book with lots of words on it. Okay. All right. So let's talk about group term life insurance. Employer paid premiums for coverage up to $50,000 are treated as a non-taxable fringe benefit. What does that mean? That means the employer, an employer paying for group life term health coverage is going to add, they'll actually be able to take a tax break on it, but it's not going to be taxable to the employee. Okay, it's a benefit that the employee gets for working there. But here's the key. The coverage amount, not the amount of premiums, but the amount of the coverage that they get can only be up to $50,000. So I don't know who knows what about coverage. What we're talking about is when you buy a premium, they're saying the premium is saying, okay, for each individual, if they were to pass away, we'll pay for that one individual up to $50,000. That's what we're going to pay. That's the coverage amount. So an employer can buy premiums for each of their employees up to $50,000 and it will not be taxable to the employee. That's what we're saying. Now, any amount above $50,000 is going to be coverage is going to be reported on the W-2. So let's say let's say, and I'm making up these amounts, but let's say it costs the company $25 to get coverage for you as an employee up to $50,000. So it costs them $25 a month to get $50,000 of coverage. That $25 a month will not be put into your income. That's a benefit that they're paying for. Now, on their end, they're actually taking a tax break, but that doesn't affect you. You as the employee are not going to pay taxes on that. Now, let's say instead of $50,000, they're going to pay $50 for $100,000 of coverage. So now that rather than paying just $25, which would be tax-free, now they're paying $50. So that extra $25 a month will be taxable to you because you've got a higher coverage amount. So the amount, the first amount, the first $25 for the first $50,000 of coverage is not taxable to you, but any amount above that they're paying is taxable. And that just is going to be put right into your W-2 as if they were earned wages. And they'll also be reported in box 12 with code C, and that'll show group term life insurance that's getting paid. Does that make sense, those limitations? And I want to give anyone a chance to ask questions. This is sometimes where people say, well, what if situations? Well, you guys seem pretty quiet. Should I move on?
Yes.
Okay. Let's talk about transportation, parking, commuting assistance. Look, there are qualified transportation costs that that some companies will give. You know, if you're living in a bigger city, sometimes they'll actually give you a riding on a commuter highway vehicle for transportation between home and the workplace. In other words, using like the bus service or the, I'm thinking like New York. You see a lot more of this in New York and places like that, or transit passes, or qualified parking in some places, even in Portland. These are benefits that are given. Any benefits, first of all, each one of these benefits have certain number limits, just like we've been looking at with educational assistance and the life insurance. There's limits where if the employer pays more than that, you're going to have to pay tax on any amount that's more than that. But as long as it's under that amount, you're not going to pay tax on any of it. And that's it. That's it. That's all you really need to know to pass the test. In real life, you would need to know more, but at least you know this, you know what it's called, you know what the basic rules are. So in real life, you go to a book and you look it up if you need to figure out what the limit is. Okay. All right. Now, de minimis benefits. De minimis is actually a Latin term that just means of minimum value. These are benefits that just simply have such a low cost or are so hard to track that they don't include it in the income. Examples, discount at a company store. What's an example of that?
Nike.
Nike, you know, Sheila, how'd you come up with that example?
Because I know that Nike employees get a discount at the Nike store.
Yeah, you're right. You're right. It's fine. No, I only say that because you stole my example right out of my mouth. No, you know why? I actually have a niece that works for Nike. She actually works in their ad department, and she gets the same thing. She gets the Nike discounts. Well, it'd be almost impossible for them to track that, so they don't try to track it. It's just she doesn't pay tax for getting that discount. Cab fare home if the employee works overtime. If you guys were working for us, for example, and you're so tired that I'm concerned about you know, driving home that night, I might actually pay for a cab or pay for an Uber to take you home. If that was to happen, you're not going to get that thrown into your income. That's just an expense that we'll absorb. Company picnics, you know, where we're paying for everything and you're just coming, you and your family are coming and enjoying the day. You don't get charged for that. Holiday gifts like a turkey or ham or something like that. Or those gifts that you guys get as part of, you know, earning your little bit of, you know, those little, we call them bonus gifts. They're not really bonus by definition, you know, that you earn throughout the tax season for like doing the cards. You get sell a certain number of cards and you get like a cup or a drinking bottle. Those are nominal gifts. Nobody's going to charge you for those. Now, however, if an employer gives a cash or a gift certificate, that's different. The values must be included as income on the tax return, regardless of the amount received. So, if we give you a bonus, cash, or we give you a gift card worth $50, you're supposed to add that into your tax return. And actually, the employer is supposed to put it in there on the W-2. Okay, so those are de minimis benefits. Most de minimis benefits are not going to be taxed. There are circumstances where they might be, and usually it boils down to is if it's a cash benefit or a gift certificate. And really a gift certificate is cash in another form. So if it's non-cash and it's small amounts, it's not going to be taxed. All right, so let's do a knowledge check here. When an employer pays a de minimis fringe benefit in the form of cash or a gift certificate, the employee can exclude that amount from tip income. True or false?
False.
That's right. It is false. That has to be and will be included on your W-2 income. Frank works for ABC Company. Now, ABC offers an educational assistance program that reimburses their employees. Now, Frank turns in receipts for his qualified expenses that total $3,700. ABC pays him $4,000 in educational assistance. How much of the assistance amount must Frank report as income?
300.
300.
That's right, the extra amount that was paid him. Marcia works for Telecorp and receives child and dependent care assistance. The amount in box 10 of her W-2 is $2,700. Marcia actually paid the provider $3,000 for qualified dependent child care services. How much of the amount in box 10 will Marcia report as income on her return?
0.
And anyone else have an answer? No, guys, don't be afraid to be wrong. I just want other people to participate before I show the answer.
Sorry.
It's okay.
Huh? How much?
I'm sorry. So how much of that would be taxable to Marcia?
I think it's 0. I don't
Okay.
know.
All right. And
I'm gonna say
go ahead.
0 too.
Okay, you guys are all right. All of you are right on this. It's 0. That's because it's under the maximum amount, and she paid more than that amount. It's that simple. If she had only paid $2,500 and got $2,700, then she'd have some taxable amount. It would have been the extra $200. Okay. All right. Now you're seeing what's new for 2017. Look, these are a few extra slides that I wanted to keep in there because I wanted you guys to see some changes that have happened over the last couple of years. There is a code FF that was added in. Those are for what's called qualified small employer health insurance, reimbursement arrangements, QSERA. That's reported because basically it's similar to the idea of a health savings account. Employers can pay or reimburse medical expenses to their employees that are in this to help them pay for medical expenses. So an employee submits, say, I paid $1,000 for this medical exam, and here's the bill, and they can pay that off. And really, this was created for the small employer health insurance. In other words, for small businesses. That's what this was created for. That code FF tells you what was reimbursed. That's all that is. Okay. Okay. So that's it for this part of the section. We have one more section to go through today. It's called interest and dividends because that's another type of income that we got to talk about what's taxable, what's not. But what I want to do is it's now 12:50. My question to you is, do you guys want a break? We should be taking a lunch break in here in theory. And there's several people here, and I want to give you guys a chance to have a lunch break. If we have one, I suggest it's a shorter lunch break than normal, say a 15-minute break rather than a 30. But what do you guys want to do?
A short break would be nice.
Okay, so let's take a 15-minute break. Let's say we'll come back at 1:05, okay? So
Yes.
at 1:05, we'll get together and
Okay.
we're going to go. Okay, it's 1:05. Ryan?
Yeah, I just started recording.
Perfect. Thank you. Oh, okay, so everyone, let's just take a look on the screen for a second. This is that federal income or not. Everything on page 1 is what we covered, and let's do just a really high-level overview. Left side is what should be included in income. What's on the right side should not be included in income. Well, in employee income, which is on a W-2, that's included. Military pay, generally, for most military pay is included. That's on a W-2. But from the military, do not include, on the right side, do not include combat pay and do not include military housing allowance. Back to the left side, tip income. Generally, you're including all tip income. You find that in W-2 boxes 7 and 8, and of course, a tip income record. Prizes, awards, and bonuses are included in income. Sick pay generally and usually will be included in income. That'll be found as part of W-2 box 1. It'll actually already be included in there is what I'm saying. However, sick pay might not be included if the premiums were paid with post-tax income. Remember, pre and post-tax. If it was paid with post-tax income, you're going to see it with a code J in box 12, and that would not be included. Disability pay. Most of the time, disability pay is going to be included in income. If you're under retirement age, it's going to be reported as regular wages. If you're of retirement age, it's no longer considered disability pay. It's just regular retirement income. Fringe benefits. Fringe benefits are included in some situations, not included in others. Generally speaking, fringe benefits are not included in income, generally speaking. For example, health insurance that's provided by the employer usually will not be included. Child and dependent care assistance usually will not be included, but will be reported for other purposes on the W-2. Adoption assistance generally will not be included, but will be put on the W-2 for other purposes. Educational assistance will not be included usually as long as it's below this amount. If it gets above that amount, it will be included. Technically, also would be included is any amount that's reimbursed to the employee that's more than the employee actually paid for education. Also not included in income is group life insurance, as long as the coverage is 50,000 or lower. In other words, coverage up to 50,000 will not be included, but anything above 50,000, the premiums for any amount above 50,000 will be included. Do not include transportation, parking, or commuting assistance up to certain limits. There's too many different numbers there. I'm not going to ask you to remember those. If they get above that, those certain limits, then they will be included. De minimis benefits, non-cash benefits, the de minimis non-cash type benefits will not be included. However, cash benefits or gift cards will be included. So that's a high-level overview of everything we just went through today. Okay? So now this is what we're going to look at next. And I'm going to go through it fairly quickly because, one, I think this next section on interest and dividends, in a sense, is fairly easy. And this is the kind of information that, while it's critical and you need to know it pretty well, this is the kind of information, if I give you the basics and we just briefly discuss it, your reading should take care of the rest of it. And this is where we just want you to interact with the material by reading it and then doing quizzes. So what to include in income? Generally speaking, you're going to include all interest and income. It'll usually be reported to you on a 1099 interest, but there are some other situations, other sources for interest. What will you not include in income? You won't include municipal bonds or things like that. You won't include, and then states are, this is really about the states. The states are not allowed to tax U.S. savings bonds and educational savings bond programs. In other words, well, we're going to talk about this, but educational savings bond program, interest from one of those, you don't include in income as long as it was used for education. And then dividends, generally you include dividends in income. And that's reported usually on a not usually, is reported on a 1099 dividend statement. So just a quick overview of that. So let's jump right into what we need to discuss here, okay? All right, interest and dividends. So we're going to talk about interest income first. Taxpayers receive interest income when they lend money to an institution or a corporation or a government or an individual, and then they receive back extra money on top of the original amount they loaned. And that might be taxable or tax exempt, depending on the circumstances. So what's taxable? Taxable is generated when the taxpayer deposits money into an institution. It's tax exempt when the taxpayer lends money by purchasing interest-bearing bonds from a government agency. So a big part of it is when it's a government-bearing agency, there's a good chance it's going to be tax exempt. And if it's to any other financial institution, most of the time it's going to be taxable. Those are just general rules. They don't cover every situation. Interest income is reported in the year that the person gets constructive receipt of it. A taxpayer constructively receives interest, or anything for that matter, when the money has been credited to their account or made available to them. An example of this might be, let's say on December 2016, since this is the example here, on December 31st of 2016, interest of $10 was credited to your account. Well, you technically could have ran down and used the interest that's in that account and bought something with it. You could, that was paid to that account, even though really you didn't have access to it or couldn't really use it until maybe January 1st or January 2nd. You still had constructive receipt because legally the law says they're going to construct it or treat it as if you actually had possession of it, even if you didn't actually use it. Constructive receipt is an important concept, and I just want to slow down just to discuss that. Oops. Constructive receipt means that you, by law, are considered to have access to it because you have realistic possession of it, even if you have in real life, have no opportunity to perhaps use it yet. So constructive, that's because they're constructing it. The law constructs the situation as if you have receipt of it, even if you cannot actively use it. So money sitting in a bank that was deposited at 5 o'clock on December 31st, you've got it, it's there, but you can't really use it yet, but it's still in your bank account already, so it's construed to be in your possession. That's what constructive receipt means. I'm going to pause right there. I just talked a bunch. I see eyes glazing over. So talk to me. Does that make sense to you?
Yes.
Can somebody give me an example of a constructive receipt that's not this? It can be something else related to, even not related to interest.
If you deposit $10,000 into your bank and the bank holds back $5,000, you still have that $10,000.
That's exactly right. Yeah, because you can still considered to have the $10,000 in your possession. That's 100% right. Good example, Lisa. Okay, so let's talk about types of interest. Interest can be in the form of a periodic payment that's made to an account, and that can be like an interest account or a savings account. It can be interest, can also be in the form of an additional amount promised to be paid in the future. That's usually what happens when somebody buys bonds. You know, you buy a bond at X number of dollars, and then the government promises, okay, you buy this bond to help us build this bridge, and we promise you that you will get X number of dollars or X percentage of increase when we buy the bond back from you. That's how those work. But that's considered interest. And certain distributions, such as those from credit unions or mutual savings bank, look, if you ever go to a credit union, they call them dividends payments, but they're not really true dividends. I've never understood why they use the word dividend, because they're not a dividend by any real definition. We haven't talked about dividends yet, but we will in a few minutes. But a true dividend is not interest. Interest is simply X number of amount that you're getting paid for the money you loaned. In the situations where you have a place like a credit union or mutual saving banks, and they're paying you these things called dividends, it's still interest. It's the equivalent of what a regular bank would call interest. And so they really are reported as interest in that situation. Now, taxable interest. This is where the rubber meets the road. We got to know what's taxable and what's not. Taxable interest includes things like bank accounts, loans made to others. You might make even a personal loan. You loan somebody $100 and they pay you 110 back. The 100 that comes back is your basis or your principal in the loan, and the $10 is interest, that the extra amount you made for making made on it for making the loan. U.S. savings bond and treasury obligations are taxable interest. Federal and state tax refunds, if interest is included in that, those would be taxable interest as well. Here's some other things that can be considered taxable interest but are not as obvious. Gifts for opening an account. Chase loves to do this. I know they're always offering, come in, open an account with us, and we'll give you $100 in your account. Well, if I do that, that $100 I have to put on my tax return as interest. Money market certificates, savings certificates, and other deferred interest accounts. What we're talking about is you put some money in there and you let them hang it up for several months to a few years. That's kind of what we're talking about. And then you get it back. You'll get back everything you put in. That's not going to be taxable because that's your original old money. But all the new money that comes from it is interest, and it's going to be treated as interest. Insurance dividends. Again, they're calling it dividends, but it's not really. It's just money that comes from an insurance account that's above and beyond the actual payment. So, you know, sometimes it takes them a while to pay something out. Well, they have to pay interest for the money they withheld for a while. Life insurance distributions. You're the beneficiary of a life insurance policy, and so you get a distribution. That is going to be treated as taxable to you. If there's interest, hold on a second, if there's interest on it.
Oh, okay.
Okay, so again, keep in mind, somebody passes away, things don't happen right away. I know this is confusing, and I knew, was that Sheila that jumped in there and tried to correct me? Yeah, it's because what's hard here to get the concept of is interest from these things. Any interest that's paid on a life insurance policy because they took a while to pay it out, because the moment they're required to pay it out, they have to pay it out, and if they don't pay it out in time, they have to start paying you interest by law on it. So in that case, they would have to pay the interest, but the interest is no different than if they paid it out in time and you threw it in a bank and got interest. It's the same thing.
Right.
And then interest from foreign source income. It doesn't matter if it comes from a foreign source, it's still taxable. So keep in mind, all of these things that we're talking about interest from that are earned on them. So now that and by the way, Sheila, thank you for being on top of that. If I had said that wrong and somebody had misunderstood, then it would be important to make sure that it's corrected. So I want to make sure that this piece makes sense because this is critical here. So anybody want to make a statement regarding this, correct anything, ask any questions? Okay. All right. So just remember, we're dealing with what is interest from these things. So what about interest that you earn on government bonds and treasury obligations? Well, interest on U.S. obligations such as U.S. Treasury bills, bonds, and notes are issued by an agency or somebody on behalf of the United States. That interest you earn on those are going to be taxable by the IRS. The IRS is going to tax those. However, there's a law that says states cannot tax U.S. obligations. What are U.S. obligations? U.S. obligations specifically are U.S. Treasury bills, notes, and bonds, and we'll talk a little bit about that in a minute. Treasury bills are ones that are issued at discounted prices. The difference between the discounted price when you buy the bill and the face value that you get back when you receive it, when you basically sell it back to the government, is interest. So really, this is not real complicated. What we're talking about is this. They sell it to you at a certain price, and they promise that it's going to be worth at least this amount or a specific amount when you buy it back. At what time? Well, some of them are short as 4 weeks, like you see on the screen, 13 weeks, 26 weeks, or 52 weeks. You notice all of these are shorter than a year. Treasury bills are a year or less. All treasury bills are a year or less. If they're longer than a year, they're not a treasury bill. So you buy it, say, on one date, and you sell it back 13 weeks later for a higher amount. That additional amount that you're getting back from that is interest, and you put that on your return. That's a bill. Treasury notes have a maturity date that ranges from 1 to 10 years. Treasury bonds have maturity periods longer than 10 years. So just to be clear, bills are less than a year. Notes are 1 to 10 years. Bonds are 10 or longer. Both bonds and notes usually pay interest every 6 months, okay? And you normally report the interest as it's received. There are some exceptions to it. They're in here. I'm not going to spend a lot of time with it because you can look at this on your own. Remember, we're going to make this all available to you through that website that Ryan showed. But just know there are different kinds of bonds. There's the H bonds and the E bonds and so on. These are called the vowel bonds because they're vowels. Each one has different rules, like the H bonds are issued at face value, the actual value. They're paid out twice a year, and they mature in 20 years or 30 years. The E bonds, they're issued with a discounted value. They're issued at below value, so you actually make more back when you cash them in or they mature. They mature in the 10-year original maturity was extended to 40, or you have two different kinds here. That's why you're seeing that different dates. But so there's some difference. Basically, just think of these as 10 to 40 because of the circumstances. They can be anywhere in there. The difference between the purchase price and the redemption value is the taxable interest. And that interest is payable when it's redeemed. In other words, that's when you pay it. It's getting paid out, but you redeem it when you redeem it. So you don't get it. You don't have to report it until you actually get all the money back. The I bonds, don't worry about what this means. It's index inflation. It's a variation of above. The face value is the interest is the face value of it plus the accrued interest and payable at maturity. Now you notice all of these are about the same thing. They're all saying, hey, when you cash it in, it's the difference in value. Okay. So these are a little bit confusing. You don't have to get this deep into them. Just know what they are. Just know when you cash them in, you're going to have to pay interest on them. Now, when you actually report it is a different matter. Interest received on the H bonds, the two different kinds of H bonds, is taxable in the year received. So when you actually get the H bonds, you actually cash it in. That's when you're going to pay and report the interest. The E bonds and I bonds, what we call the vowel bonds, you can use one of two methods. You can either hold off and report all the interest when you sell the bonds all at once, or the year it matures, whichever's earlier, or you can use the method 2, which is you report the interest each year as you receive it. Whatever method you choose, you're either waiting to the end or you're reporting it year by year as you receive it. You can only do that with the vowel bonds, and you can choose either method, but whichever method you use, you have to use it consistently for the rest of the time. The taxpayer must use, well, I just said that, you must use the same method for all the series. So if you have a series EE bonds, you have to use them for all your EE bonds, whichever method you choose.
Yes.
Guys, I want to pause here. That is a little bit confusing even to me. I have to be careful the way I'm wording this. That's why I'm reading a lot to make sure I don't stumble over my words. And I'm going pretty fast, and I know I am on this. Is there anything that throws you off or you want to ask about here? Because I use you guys as the guide to see whether or not we need to discuss this further.
I have a question, but I got to figure out how to word it.
Fair enough. We'll wait.
So when you report the increase in redemption value as interest each year, so it just goes, you're just paying the interest from, so the redemption value from one point to the other point, and you pay that interest, and then next year, just this little bit that it goes up the next year?
Yeah, that's right. Yeah, that's right. Remember, on bonds, they're a little different. They're not true interest. They're manipulated amounts where the government wants you to loan them money so they can do things like build bridges or whatever they're going to do. And so they get you to do that. And so what they might do, and they do it different ways, but they might say, okay, here you can buy this bond for X number of dollars, and we guarantee you that we're going to pay you this amount in, say, 10 years, or maybe even higher. They're not all exactly always set the exact dollar amount, okay? But they're going to guarantee that a certain amount is paid. As you go through each year, the amount that they divided up and say that you earned for that first year, they're going to pay it to you. And be honest with you, to be totally accurate, it's actually getting paid every 6 months to you. But they pay it to you. So you have two payments in, say, 2019. At the end of 2019, you can choose to say, okay, I'm not going to include it yet. I'm going to wait till it matures. Or, no, I want to include it now, my little bit now. And then next year, the amount, it goes up some more for 2020. So for 2020, if you choose to report it, you go along, it's the amount that increases for that particular year. And you find that out from the people that are handling the bond for you. They would know how much it's going up for that year. Does that help?
Yes.
Okay, perfect. Any other questions? That was a great question. Okay. Beyond that, guys, I don't want to have you worry too much about it, but on the savings bonds, though, just touching on that, those are, if you have co-owners, more than one person joins in on it, you can do that. But the first name of the co-owners, the first name listed is the one who's actually going to be responsible for the taxability of it. Somebody has to be responsible for it. So that's how they do it. I don't see that happen at least in our practice. We don't see it a lot, but for testing purposes, just know it's the first person. If the taxpayer and spouse live in a community property state and holds the bonds as community property, half the interest is considered by function of IRS law. Each of them have received half of it. Look, that's a general rule. That general rule exists for almost everything in community property states: income, expenses, everything. So community property states, is Oregon a community property state?
No.
No.
Okay. Who is a community property state in the Northwest?
Washington.
Washington?
Washington is. Anyone else that you can think of around us?
California.
Yep, California is. Yep, that's exactly right. Good. Now, water educational saving bond program. What is that? Look, it's real simple. We just talked about bonds, bills, bonds, and notes. If you have purchased a U.S. savings bond of any kind and you withdraw it out and use it to pay for educational expenses, you're not going to get taxed on it. If you withdraw it for any other purpose, you're going to get taxed on it. Well, of course, you're going to get taxed on the interest of it, normally. So, but if you use that and draw it out to buy, to pay for higher education for you or your dependent, then you're not going to get taxed on it. So let me give you a simple example. Let's say you have a bond that you bought several years ago for $10,000 and now it's worth $12,000. If you go in and withdraw that, it's time to cash it in. It's matured and you cash it in now. Now you've gotten $12,000. Are you going to get taxed on that $10,000 that you initially put in?
No.
No.
No, of course
No.
not, because that's already old income. And that's why I want to introduce that concept that I've said a few times: old money and new money. That's old money. That's money that's already been taxed. They're not going to tax you a second time on the old money. So you're only going to get taxed on the $2,000. That's interest. That's new money. You're going to get taxed on that. But how can you avoid tax on that? Well, if you use that money that you would have otherwise gotten taxed on to pay for college, then you will not get taxed on it.
If a
Okay.
parent buys a savings bond and uses the money to pay for the kids' college, is that
Yes.
in this?
Yes. Yes, it would be. Yeah. No, they can do that. They can do that. And look, it's the parents that are responsible for any taxes coming from those bonds because it's in their name. So if it's in their name and they take it out to pay for the kids' education, yes, it is excludable. If they open the bond in the name of the child, then it would be taxable to the child. But if the child uses it to pay for college, then it's not going to be taxed. That's exactly right. And remember when we were talking about filing statuses, that it's usually more beneficial to file jointly rather than separately, MFJ rather than MFS. Here's an example of it. If you file MFS, then you don't get to take advantage of this. Even if you did draw this out and give it to your child to pay for his college, you're still going to get taxed on it if you're filing MFS. You have to file it. If you're married, you have to file MFJ or qualify as head of household to still be able to use this. Okay. Okay, so let's talk about this. For federal purposes, which transaction is not taxable? Interest income of $853 from a loan. In fact, I'm just going to let you guys read through that, and then somebody just tell me what you think the answer is. Oh, somebody wrote something. Okay. Who else has answers? You can either write it in or tell me right now. Okay. So here comes the answer. It's B. It's okay. It's B. Why is that? Interest accrued on a T-bill that has not yet matured. Because at Treasury, remember a bill, you don't claim until it matures. There's not going to be a payment to you at all until it matures. That's a bill. The bonds and the notes are paid out every 6 months. A Treasury bill is less than a year, and you don't get any money from it until it matures in that that period of time. That's the reason. Okay. Let's try another one here. The taxpayer must report as blank as taxable interest on their federal return. A, B, C, or D? Lisa's got hers in there. Who else has an answer to type in there?
Can we use a 50-50?
Call a friend.
Phone a friend.
Well, if actually one of the testing things, if you can knock out 2, then you are down to 50-50. Okay, everyone ready? Here comes the answer. D, gifts from a bank. Municipal bond earnings. Boy, we haven't talked about that yet. That was kind of out of. We'll talk about that later. Municipal bonds are bonds done by a city, and those are not taxable by the IRS. Roth IRA earnings. You haven't even talked about IRAs yet, but this is specific kind of IRA that is not taxable if you meet the requirements. Backup withholding. Don't worry about it. You guys have the right answer. Gifts from a bank. That's what's taxable. Let's do the next one. So the next one is which interest is taxable on a federal return but not taxable on a state return? Waiting for more people to reply.
A.
Okay. All right. That's right. A, U.S. savings bonds. Corporate bonds are for corporations. Those are going to be taxable almost always. Interest from a credit union is always taxable. Well, actually, that's not true, but in most cases, it's taxable. U.S. savings bonds are the ones that can be taxed by on a federal return, but they do not allow the states to tax it. So let's do number 4 now. Okay. Question 4. The interest received on a series EE bonds is blank. Garrett has his up. Everybody type in your answer. Okay, I think I got everyone's. And the answer is A. Y'all got that answer. Perfect. When it's either received or matured or disposed of, remember there were some options there that we didn't go into. Yeah, we did not go into detail on it because this is about as much detail as you need for our purposes right now. Okay. So now let's talk about non-taxable and tax-exempt interest, okay? Some types of interest may be non-taxable or tax-exempt, such as interest from a state or local government obligations. That's why I said they had that one question kind of out of order. And I think we're going to talk about it more, but while I'm thinking about it, we're going to discuss it. Money that comes from a city or municipality or a state, those are all, I group those all as muni bonds or municipal bonds. Technically, a state bond is not a muni bond, but remember it that way. Anything that's municipal, local bonds, those are exempt from tax, okay? And they're reported right there. I know this is a little hard to see, but on the Form 1040, line 2, you have 2 boxes. You have a 2A and a 2B. The tax exempt interest is on 2A. The taxable interest is on 2B. You just separate those. And you do have a requirement when you have tax exempt interest to report it, but it will not be added into your taxable income. So there's the state or local government obligations. Municipal bonds are debt securities that cities, states, counties, government entities issue. And they use them to pay for things such as highways, and I kept using the example of bridges earlier, things like that. When an individual purchases a muni bond, they're lending the money to the issuer and the government entity that issued the bond. Look, this is not really underneath any different than what the federal government does. Theirs is just a lot more complicated. Local bonds or muni bonds are a lot simpler and more straightforward, usually tied in with a specific project. And the issuer will promise to pay a specified amount of interest, usually done every 6 months, semi-annually. And the IRS has said they will not tax muni bonds. So somebody that wants to buy muni bonds to help the local community, the IRS says, look, we're going to give you a break there. We're not going to tax that. Why? Because they're trying to encourage people to invest in their own local governments. And this is one way to do it, is to remove any interest earned from that local government. If you do, they're going to remove that from your taxes. States usually do not tax their own muni bonds, and that's true for Oregon. So if you buy municipal bonds in Oregon, like for Salem or the city of Portland or something like that, or the county of Multnomah, if you do that, IRS is not going to tax the interest you earned, and neither is Oregon. So that's how those work. If you buy a muni bond for Vancouver, Washington, will the IRS tax that?
Yeah.
Yes.
If you buy a municipal bond from Vancouver, Washington, will IRS tax a municipal bond?
No, because it's still a local thing. It's not a
That's
US.
right, exactly. That's what I'm trying to get. But will Oregon tax it?
Yes.
Yeah, they will. Oregon will tax it. But here's what you need to know for the EA. Municipal bonds or anything similar to a muni bond, like a state bond or any government that's a state or lower, any bond that you get, the interest you earn from it, the IRS will not tax. That's what I want you to hear. So if you buy a municipal bond from San Diego, California, will IRS tax it?
No.
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 If you buy a municipal bond from Atlanta, Georgia, will IRS tax it?
No.
No.
This isn't a trick question, guys. It really is okay. It really is okay. It's just you seem hesitant. The important thing is these are all municipal bonds. If it's a muni bond, the IRS is not going to tax it, period. The state might tax it depending on which state we're talking about.
Ah, okay. Yeah.
That's what you keep separate. That's what you keep separate. I don't want to get into Oregon and not Oregon because right now we're trying to help you pass the enrolled agent exam. I introduced the concept that most states will not tax their own muni bonds, but will tax another state's muni bonds. I introduced it because you kind of want to know that information, but what's critical here is that you know the IRS will never tax a muni bond. Okay?
Mhm.
Okay.
Any questions, clarifications on that? It sounds like someone, I guess that was Noemi. It sounds like that kind of clarified it for you, did it?
Yes.
Okay. Any questions about that? All right, we're just going to move on. Let's talk about IRAs. What are IRAs? These are individual retirement arrangements. These are what they call tax deferred. Individual retirement arrangement is another way to save for retirement. You normally, but not always, will set these up yourself, and just after you get your paychecks, you just write a check and put some money in there every month or once a year, or however you choose to do it. You put some money into it to save for retirement. Okay. Now there are two different IRAs. There's a traditional IRA and there's a Roth IRA. Traditional IRA, if you put money into it, you're going to get a tax break. You take it on your tax return. Okay, so let me give you two situations where you can do this. In rare circumstances, there is a traditional IRA that can be set up through your employer. There are circumstances where it can happen. I shouldn't say rare. But if you do that, you can have pre-tax dollars taken out. You're going to get your tax break right away, and the employer's simply going to take your income you earned and subtract out whatever you put into the IRA. What's left over, you get taxed on. So now you've already got your tax break. You don't have to worry about taking a tax break on your tax return. But you can also, and most people are this way if they have an IRA and they don't have any kind of retirement account at work, they're going to just get their paychecks every month and they got to put the money in there. Well, if you're going to get a tax break for that, you have to put it on your return and do a calculation and then put it on the return so you get a deduction for it. Okay? You don't know how to do that yet. We're not going to worry about that right now. Just know you can get a deduction on your return for that. A Roth IRA is not that way. You're not going to get a tax break on it. It's because it's all done with after-tax dollars and you're not going to ask on the return to get a tax break for it now. But what's the benefit of a Roth IRA? I told you earlier, when you get the money back, you're also not going to get taxed on any of it, including the interest. You're not going to get taxed on it. Okay? Oh, I heard, oh, does that mean you want to ask something?
No.
Okay, that's okay. All right, so we'll get into IRAs more, and I'm taking a look at our list here. It looks like a little bit later. I was trying to remember what order this came in our presentation. So let's talk about receiving and reporting interest. Now that you kind of know what's there, how do you know where to find the interest and how to report it? For most of the time, most of your interest is going to be reported on a 1099-INT interest income statement. You'll find your basic interest right there in box 1. This is taxable, federal, and states. Box 3 is interest on U.S. savings, bonds, treasury obligations. This is taxable with the IRS. The IRS will tax this, but remember there's a law that says the states are not allowed to tax this. That's why they have to report this separately. Okay, that's why it's reported separately. And then there's tax exempt interest. This is interest that is subject usually to muni bonds and stuff of that nature where it's going to be exempt from tax. Many times that exemption is going to apply to, to the IRS, but might or might not apply to the state. So there's a reason it's here. This is going to always be taxed. This is going to be taxed by both IRS and the state. This is going to be taxed only by the IRS, and this is probably only going to be taxed in most cases by the state or certain states, okay? Don't worry about getting into it other than to know that's why we have different, 3 different boxes. So interest that payers are required to, try again, interest payers are required to provide a taxpayer with a Form 1099 interest or similar statement if they earned more than $10. So if they earned less than $10, if you have a bank that's only paying like a cent a month, an account, you're not going to have enough at the end of the year. You may not get a statement on this. And but are you still supposed to include any interest you earned?
Of course.
Yes.
Of course. Yeah, you bet. All interest should be included, whether it's reported to you or not, but they are required by law to report it on a 1099-INT or similar statement if it's more than $10. They're required to make that report by January 31st. What else is due on January 31st?
W-2.
W-2, that's exactly right.
1099.
Yeah, and 1099 and a bunch of other stuff, to tell you the truth, too. But the W-2 is what I was thinking about because that's what we had already discussed. Anytime there's interest being paid, the taxpayer, the person that's done the loan, is required to provide a tax identification number. That's usually a Social Security number, but it can be one of the other types of numbers like an ITIN, for example. If they refuse to or fail to provide that, that means the bank or institution that's paying the interest is required to do special backup withholding, and that's high percentage rate. Okay, just know that. I don't care about the percentage rate that you memorize it, but just know that they're required to do backup withholding. So here's the thing. You report all interest income that a taxpayer receives for the tax year, even if they do not receive a 1099-INT or substitute statement. Okay?
Yes.
Reporting. Where do you report it? Well, we already showed you. You report it on box 2A or 2B, depending on the circumstances. So let's take a look here. Where is it reported to you? Well, let's take a look. On a 1099 interest in box 1, that's interest income. That's that general interest income that I said is taxable by both IRS and the states. That's reported in box 1. And then, that's reported to you in box 1, and then you put it on Form 1040 on page 2 in line 2B, right there. Okay? Interest on U.S. obligations, that's reported on the 1099-INT in box 3. Well, that's taxable by the IRS, so you report that on that same line. So if you had amount in box 1 and box 3, what do? Add it together. You add them together, and then you put the total amount in on that line right there. Now, what about tax-exempt interest, such as interest from a state or local government obligations? Does the IRS tax muni bonds?
No.
No. So the amount in box 8 you report on line 2A. And Sheila, what is
Yes.
box 2A on the Form 1040?
Tax-exempt interest.
Exactly. Tax-exempt interest. So that's what you're doing. You're putting it there because the IRS is not going to tax that, but you still have to report it to them so they don't get confused if somebody's looking at it and they realize, oh, that's tax-exempt interest. We're not going to tax that. Perfect. All right, now what they're trying to do here is just show you the equivalent on a 1099 substitute statement. Look, you often get these consolidated year-end statements, and it'll have a 1099 interest on it, 1099-dividend, which we'll talk about it in a minute, and other things. They may look like this, but if it says interest income 1099-INT, this is the equivalent of a box 1 on a true 1099-INT. This is the equivalent of that. Interest on a U.S. savings bond, line 3 is equivalent of box 3. Line 8 for tax-exempt interest is the equivalent of box 8. That's all they're trying to show you. This is just one kind of substitute statement. If you ever are uncertain, you just take a moment to look at it and you'll quickly realize what they're doing. Now, will you get one of these on the exam? Probably not. but they could potentially ask you if a substitute statement is acceptable. Well, sure it is, as long as it's got the right information on it. Okay, so let's do a quiz here. Which of the following statements is true? A, B, C, or D? Enter your answer into the question bank there. Waiting for Amanda to get her answer in there. Amanda? Perfect. Yeah, you guys are good. That's exactly right. It's not part of the federal AGI because it's not taxable, but it is reported on there. Good job. Let's do question 2. Which of the following represents a federally tax-exempt obligation? So in other words, the IRS will not tax it. Okay, I think I have everyone, and you're right. Hey, good job. Everybody got that right. That's because U.S. Treasury bonds and notes, U.S. obligations are taxable by the IRS. And of course, regular savings account interest is. But muni bonds from New York are not. Question 3. Although tax exempt for federal tax purposes, which interest might be taxable to the taxpayer's state? A, B, C, or D?
Ay, mali. Ano ba yan? Municipal bonds, not from their home state.
Yes, that's right. That's right.
Yeah.
Muni bonds. Remember, municipal bonds, we call them muni bonds for short, and we include really even other state bonds in there, you know, state government. Okay, good job. Everybody's getting all these right. Interest accumulating on an IRA must be reported each year on the taxpayer's return. True or false? You can just speak up on this one. Is that true or false?
False.
False.
He agrees.
Yeah, right.
The Rugrat agrees. Okay, and you guys are right. It's false. You don't report that. You don't start reporting getting taxed on your traditional IRA until you pull the traditional IRA out. Okay. Now we've talked about interest. Now let's talk about, for a moment, about dividends. When a person buys, okay, you've heard of the stock market. When a person buys like into the stock market, they're buying a share of the stock market. When they do that, that investment now is money that they've effectively loaned to a company, and that company, as they earn money, are going to start paying some money back. Now, they don't necessarily have to pay dollar for dollar and all of the money back, but they have to pay some of it back as they earn some money. They're only allowed to accumulate so much. They have to pay some back to the investors, and that payment comes from their earnings. So this is what's critical. We're not talking about selling the stock back. So you buy stock and you can sell stock. That's important information, but that's not what we're talking about. We're talking about you buy it and you're holding it for several years. Well, as you hold it each year, the company, if it made a profit, is going to share some of that profit with you by giving you some money back. And they're not giving you back your original investment. They're giving you a part of the profits back. When they're giving you a part of the profits back, those are called dividends. This is why we said, when we were talking about interest, that there are places like credit unions that pay interest, and they call them dividends. They're not dividends. That's not part of the company's profit, that's a credit union's profit. It's not. A true dividend means the company you invested in is sharing part of the profit with you. That's what that means, okay? Dividends can be distributions of money, stock, or other property. In other words, most of the time when we're thinking dividends, we're thinking actual money sent to you. But actually, they can do dividends by giving you more stock. In other words, suddenly you go from one stock to owning two stocks, which means you could potentially get even more dividends back. That's one way they can pay you. Another way they can pay you is by giving you some kind of property. And usually that does not happen with big corporations on the stock market. That's more like when you have a small privately held corporation where they might, give you something. Like, for instance, maybe there's a car that you'd like and they know they owe you some money, and so, hey, this company will just give you the car in return as part of your payment. Now, some amounts received are called as dividends, but actually interest. That's what we just talked about a moment ago. There's also a thing called a regulated investment company, or a RIC, but regulated investment company. We mostly know them as mutual funds. That's where people group together to buy groups of stock. In that situation, distributions from them are considered dividends. So what you're doing there is you're not really buying individual stock in like PGE or individual stock in Nestle, for example. You're actually buying into a group of people who are pooling their money together. That's what makes it a mutual fund. And then somebody in charge of the mutual fund, the investor, is buying different things. And so when the mutual fund makes money, they're going to give you a dividend, because that buying into mutual fund is almost like buying into a company itself. Okay. So there's a difference between, there's different kinds of dividends. There's ordinary dividends and qualified dividends. And ordinary dividends is the most common kind of distribution. This is the kind that we've been talking about. The company has made earnings, made a profit, and they're sharing part of it with you. They're not returning your original investment to you. They're sharing part of the profit with you. Ordinary dividends are taxed at ordinary tax rates. What are ordinary tax rates? Can somebody tell me what I mean by that?
It's whatever the tax rate is for your tax bracket.
That's exactly right. Yeah. So every individual, when you're doing a tax return, some people may be in the 10% tax bracket, some may be in the 15%, and so on, which of course is not really 15% now, because they changed the tax brackets a little bit. But anyway, you get my point though. If you different tax brackets, I may sit down and deal with a client that's in a 10% bracket. Noemi might turn around and do a tax return that's in the, say, the 20% tax bracket. So if they have dividends, if my client has dividends and so does hers, these ordinary dividends for my client will be taxed at 10%. Her client's dividends will be taxed at 20%. It's based on the tax return for that particular year. Does that make sense? This is an important concept that you could be tested on. Does that make sense, what an ordinary dividend is and how you get taxed on it?
Yeah.
Okay. Okay, good enough. So what are qualified dividends? These are a little bit trickier. These are ordinary dividends that are paid by a U.S. domestic corporation or a qualified foreign corporation. So how much of this do I want you to know of that part of the definition? Well, first of all, know a qualified dividend can only come from a domestic U.S. corporation. What does domestic mean in this situation? Can somebody tell me what that means when we're talking about U.S. Domestic U.S. corporation?
Corporation based in the U.S.
That's exactly right. Domestic just meaning it's based in the U.S. So domestic U.S. corporation or a qualified foreign corporation. That means a corporation that's somewhere based somewhere other than the U.S., but for various reasons it qualifies as if it was a U.S. domestic corporation. Now, they are eligible for reduced tax rates. If you have qualified dividends, those are eligible for reduced tax rates when a certain special holding period requirement is applied. Okay. Holding period requirement means you bought this and you held it for a specific period of time within a specific, this is where it gets confusing. It has to do with when stock is made available for purchase and you purchase it and hold it for within that specific period of time. I'm not going to get into the definition. I honestly have forgotten when I looked at these slides if they get into the definition. It's kind of complicated, but for now, just know if you meet the holding period requirement, then you're going to be able to potentially get taxed at a lower rate. What is that lower rate? Well, if your regular tax rate is 10 or 15%, then this is going to be taxed at 0%. If your tax rate is between 15% and 39.6%, you get taxed at 15%. If your regular tax rate is 39.6%, you get taxed at 20%. Okay. So many people, let's say I'm doing a tax return for somebody that normally is in the 15% tax rate, but they have some qualified dividends. How much taxes are they going to pay on the qualified dividends?
Zero.
Zero. Because it's 0% if their regular tax rate is 15%. That's exactly right. Now, I've got to let you know, this is where it gets a little more tricky for you guys that are right at this switch over from 2017 and earlier tax law to 2018 and later. They changed the tax rates. The qualified dividend rate, you know, is actually still 0, 15, or 20, but the tax rates, the regular tax rates are changed. So the tax rate 10% is still good. Just know this, anything that is 10% or higher up to 15% is still 0%. Anything between, and then after that, it still goes to 15% to 39.6, still goes to 15, and anything higher than 39.6 is still 20%. So all of those help. Now, have you heard the term capital gain tax rate?
Of course.
Okay. And Sheila said, of course. Noemi, have you heard of it?
Yes.
Okay. Lisa? Have
Yes.
you heard of that? Okay. I'm just wondering who's heard the term. Garrett, have you heard that? Capital gain tax rate? The term, I mean, I can't hear you. I know you're trying to talk, but I can't hear you. Think you got yourself muted, maybe?
Is that better?
Yeah, that's much better. Now I can hear you.
Okay. Button on my
It's okay.
microphone. Sorry.
All right.
Yes, I've heard that before. Yes.
Okay, and Amanda, I want to check with you. Have you heard that term, capital gain tax rate?
Yes, I have.
Okay, so I want one person to volunteer to answer this question. Are capital gain tax rates a good thing or a bad thing for clients? Who wants to answer that question?
They're a bad thing because they
Bad.
are normal.
Okay, that's what most people say. Now, not meaning to put you on the spot here, but did you know what you're looking at are capital gain tax rates? That's what these are. I'm introducing the concept because you'll see this again. These are actually capital gain tax rates. What capital gain tax rates mean is if you meet the requirements, you're going to pay less tax than your regular rate. Capital gain tax rates, if you got a client in front of you that wants to, that has the potential to have ordinary dividends or have capital gains, they could potentially pay less taxes because they have capital gains and the capital gain tax rate. If you can ever apply a capital gain tax rate to your client, then do it because they're going to pay less tax.
So say their regular job only pays like $15,000, but they sell and buy stocks and they make who knows how much, they'll be taxed at 0% for that?
No, because your question was if they buy and sell stock. Dividends are not the what you make when you sell a stock. Remember that?
Okay, when you said capital gains, I'm confused.
Oh, I see what you mean. Yeah, okay, I see. You're jumping ahead. Yeah, actually, the answer is yes to your question. I hesitate to jump too far ahead to those that don't know what we're talking about with the sale of stock, but just to help you out, the answer is yes. They could potentially not be taxed on that if they meet other requirements for capital gains. Potentially, but here's potentially.
So we'll learn more later.
Yeah, it's because capital gains, there's a lot more to it. We haven't discussed even what capital is yet. But capital gains, I'm introducing it now because this is the first inclination of being introduced to capital gain tax rates. We're just applying it only to dividends, to qualified dividends. So, but these really are capital gain tax rates. It's just but to answer your question in short, yes, if you have capital gains, and that's a type of capital gain, a person could potentially, just like you said, end up paying very little tax in a year. You know, even because they have capital gains and very little other income. That's very possible. Okay. Great question. Anybody else? Okay. All right. Now let's talk about mutual funds. A mutual fund, like I said, is a pool of investors. It's rather than you going out and buying your own investments in Nestle and in AT&T. A group of you throw your money together and do it through a mutual fund. Now, I mean, you couldn't just do it with you and some friends. You'd have to actually go through somebody who's licensed to do this. But you can throw it in with other investors, and then as a group, shares of stock are purchased and everything. And then the investor shares in the fund, and a money market is one type of mutual fund. That's one that's usually done by a bank. But that's not true. Even investors do this. You can have different kinds. This is a very common kind, but it's not the only kind. But that's all a mutual fund is, okay? So part of the taxable dividend from a mutual fund might actually come from a U.S. obligation. And we know that states cannot tax U.S. obligations. And some states do not tax any dividends paid to the taxpayer by a mutual fund. And the reason they don't is some of them say, well, if a mutual fund is a pool of stuff from many different sources, how do you keep it all separate? You know, how do you know how much of it's from U.S. obligations and how much it's from something else that is taxable? That's hard to keep separate. So some states will not tax a mutual fund at all. Just to let you know, Oregon is not one of them. Oregon will tax a mutual fund. Other states will tax dividends if they're less than a certain percentage of the mutual fund's total income. So all we're saying is, look, when you got a mutual fund, you might have some non-taxable stuff mixed in there. It won't matter and so it's really difficult to determine how much is going to be taxed and how much is not. What you do is you look at the detailed account of what's there. When they send you the 1099 interest or 1099 div, there's a detail statement that's attached to it, and that's how you have to drill into it to figure it out if it matters. So that's all. Okay. So those are mutual funds, and that's only applies to a mutual fund. Capital gains, we just talked about that. One of the ways a mutual fund makes money for its investors is to sell assets at a gain. Okay, if the asset was held by a mutual fund for less than a year, the nature of the income is a capital gain. In other words, they have something and they held it for less than a year and turned around and sold it. That's going to be treated as a capital gain. Capital gain distributions are taxed as long-term capital gains regardless of how long they're held. So when you start reporting stuff on a tax return, there are certain rules, and wish they had taught this already, but I'll touch on it now. If you hold something for less than a year, it's called short-term. If you hold it for a year or longer, it's called long-term. So short-term holding, long-term holding. Year or less, longer than a year. Okay. And in a mutual fund, if they hold it for, if they have a capital gain distribution, regardless of how long it's held, it's treated as a long-term capital gain, even if it really was not long-term. It's an exception to the rule. And they are taxed, in that case, they are taxed at the same reduced capital gains rate as qualified dividends. Okay, this is why I introduced it a second ago when we showed that. Remember I said capital gain tax rates? Why are they doing this? Because they're given a special, the IRS laws are giving special treatment to mutual funds. Mutual funds will always, even if they're held for less than a year, it's going to be treated as a capital gain and treated as a long-term capital gain. Well, long-term capital gain get to use capital gain tax rates. Short-term capital gains have to use ordinary tax rates. You following that?
Yeah.
Short-term capital gains, and I know we haven't really talked about capital gains here much, but we're touching on it. Short-term capital gains are taxed at your ordinary tax rate, if you're 10% or 15% or whatever it is. But there's a benefit. If something's long-term capital, it fits into long-term capital gain, long-term, it can be a capital gain tax, it can be treated as long-term capital gain, can get a capital gain tax treatment, and that's a good thing. So
because capital gains held for a longer period of time are taxed at a lower rate.
Can be, yeah. Keep in mind, they actually, in real life, you're running a comparison between the normal rate versus the capital gain rate, and it gives you whichever's better. That's what it's actually doing, just to let you know. But generally speaking, think of it in terms of capital gain tax rate many times save people money. If it doesn't, if it's cheaper to use your ordinary rate, they'll use your ordinary rate, whatever works best for the client. But yes, what you said is true. Long-term is allowed long-term capital gain treatment, and that's a good thing. That's why there's a special rule for these mutual funds. If you have a mutual fund that you held for less than a year, and then they turn around and sold it, it's still going to be treated as long-term capital gain regardless. Why? Because IRS wanted to give it that long-term capital gain treatment anyway. That's why. Okay. Any questions about that? Before I jump past this one page here?
No.
Okay. All right. So we've talked about dividend distributions from a couple different sources. So quickly, before we go any further, what is a dividend? I want somebody to define for me what is a dividend payment. What does that mean, a dividend?
A distribution you receive from a company in which you own a share?
Yes, but it is a distribution, but you can receive other kinds of distributions from a company in which you own a share. So what makes this different than the other kinds of distribution? What makes a dividend distribution different?
It is a profit.
It comes from the profits. Okay? Because what you said was 100% right, Amanda. It's just you needed to distinguish, though, that a dividend distribution comes from the profits of the company, not from anything else. What about non-dividend distributions? Here's an example where you can get money, like you were saying, from a company but it's not coming from the profits. That's what these are. A taxpayer may receive a non-dividend distribution which is not paid from the earning and profits of a corporation. A non-dividend distribution is called a return of capital, and it is a return of the taxpayer's investment in the stock of the company. Okay, so let me give you an example. Let's say I go and I buy into PG&E. Let's say I go buy stock in PG&E and I spend $1,000 to buy one share of stock in PG&E. I have no idea what their stock is worth, but that's what we're saying. So I paid $1,000. That's my investment in that. That's my capital in that. That's my capital investment in that. Okay? if I get that when I get that $1,000 back, am I going to get taxed on that at all?
No.
No, because that's my investment in it. I get that back. That's my, what did I say? What kind of money is it? Old money or new money?
Old money.
Old money. That's my old money in that. So that's my old money in that. I get that back. Okay. But when I am given, so when I'm given that $1,000 back, that's also a distribution. It's called a non-dividend distribution. Okay, because it's not being paid out of the earnings and profits. It's the company returning to me my original money. Okay, it's a return of my capital. So that's a non-dividend distribution, which makes sense if you think about it. Dividend distribution is money I get, a distribution I get from the profits of the company. Non-dividend distribution is money I receive back from my original investment, my capital in it. Now, there's a lot more to this, and we're going to go into it a little bit, but I don't want to get too deep into this because we could spend an entire 4-hour session talking about this and how companies handle this, but we don't need to get that far into it to help you with this, with part 1 here. So non-dividend distributions are considered fully or partially taxable as dividends only because the paying corporation's current and accumulated earnings and profits are less than the distributions. Let me think about this for a second. I'm trying to figure out how much you really need to know about this. This is getting pretty deep.
You bet. Especially if we're looking at liquidations or redemptions.
Yeah, it's, well, that's right. That's right now. No, I mean, see, you're understanding more than the average person, but keep in mind, I'm trying not to confuse the person who's never been exposed to this before.
Yep.
Here's where things can get a little tricky here. As a company, I'm kind of stepping away from the slide for a second. As a company goes about and is earning profits, they are required by law to share some of the profits. They are not, they are allowed, but they are allowed to accumulate some and keep accumulating some, but they can't accumulate all of it. Okay. And they can do that currently or accumulate it over time. Okay. So, but what if their current and accumulated profits from several years are less than the distribution amount? Okay. So to put this a little differently, what if they only earned $100,000 this year, but they're distributing $125,000? Let's say they distribute $125,000. $100,000 of that distribution is actually their earnings and profits, both their current and accumulated over the years. But the other $25,000 is coming from where?
The capital of the company.
That's right. And what is the capital of the company?
The money that's been invested.
No.
No, not really, because that's what you put in there, and that's not exactly. The money that was invested is what you put in there. The capital of the company. Noemi, could you give them a good definition? I'm actually drawing a blank on how to define capital of a company at the moment. Can you help?
Well, the assets of the company, not necessarily assets, but the worth of the company.
The worth of the company, yeah. So what can be included in that? Well, things they actually own. They own buildings, they own machinery. Those are not investments. They were bought with investments from the investors, but they're things the company actually owns. Sort of a similar example would be, what are your personal assets? Your home, your car, so on. A company can own things too. They can own a building. They can own vehicles. They can own actually goodwill of a company. Those are all assets of a company. So if they return $25,000 worth of assets to their investors just to keep them on board while they're trying to make money, that's what we're talking about. Would you agree with that explanation, Noemi?
Yes.
Okay. Okay. So, and who else was helping me with that a moment ago? I'm sorry, I'm drawing a blank. Who was just talking a second ago? Sheila. Okay, Sheila. Sheila, would you agree with that as well? That
Yes.
explanation. Okay, I want to make sure I'm describing this in a way that makes sense. So that was really deep. And you know what? It's still going to help you guys because I want you to know you're going to deal with this in part 2 of the EA stuff. This is part of what you got to learn. And I feel like we're a little deeper than you need for part 1, but I don't think it's hurting us because understanding it now also helps you not only now but later. So repeating what's here on the screen then, non-dividend distributions might be considered fully taxable or partially non-taxable as dividends because the corporation is paying something more than their profits. They're returning more than what they made, which means it's coming from their assets. And when that happens, what somebody gets back in the form of dividends, I'm talking what the investors get back that is more than, that is part of dividends, what they get that back, that can potentially be taxable to them. So I think an example might help here. Let's say I invest $1,000 in PGE, okay? And that's my asset. That's my personal investment in it. But let's say PGE has a bad year and they're returning non-dividend distributions. So they've returned more to, they've returned to me and some other investors more than they earned during the year, okay? So I might have, as a non-dividend distribution, I might have $500 in there. That $500 is a return, is potentially going to be taxable to me. Potentially. Why? Because keep in mind, I haven't sold the stock yet. It's not like I got rid of the investment. I haven't sold the stock yet. And what would I do with that? I would use that to decrease my investment. So if I had originally bought $1,000 and I got $500 non-dividend distribution, what do I do with that? I take my $1,000 investment, subtract out my $500 that I got, and what's left over is now my investment, the other $500. Okay, now I want to ask an honest question. It's okay to say, did that help or did that confuse what I just said? Please tell me the truth here.
So are you selling the $500 or are you just saying now I got only $500?
No. You didn't sell it. They forced you to take back. What they did is they gave to you some of your, right. They gave to you some of their value of the company is what they did. See, this is where it gets so tricky. This is the tricky part. This is where we got to slow down and think this through. If you have an investment in a company, okay, if you have an investment in a company and that company, they have to keep track of their own investment, their own net worth and everything and income and what they're paying back to you. And separately, though, you have to keep track of your own investment in the company, okay? So I can invest $1,000 in PGE, which means now they have $1,000 more to work with. And when they pay me from their profits, not a problem. That doesn't affect their capital or my capital. But what happens when they start saying, well, we're going to give you some money back. Some of it's going to be from our profits. Those are ordinary dividends. But some of it's going to be from our own assets. And we're going to give it to you. Now they're decreasing their value, which is also going to have an effect on your value.
So that one stock that you bought for $1,000 is now only worth $500.
That's exactly correct. For you. Okay.
I got that part.
Yeah, right. So now I'm going to take it a step further because I think this is helping. I think. Let's say similar situation, but let's say rather than a non-dividend distribution of $500 to me. They did a non-dividend distribution of $1,000 to me. What is my stock worth? What, not worth, that's the wrong word. What is my investment in that stock now?
Nothing.
Nothing. But am I going to get taxed on that extra $1,000 they gave to me?
No, because it's a non-taxable distribution.
Right. And why is it non-taxable? It's non-taxable, and I want to answer this one, Sheila, because I want to make sure to make a point here.
Okay.
It's non-taxable because I have had to pay for it by reducing my value in the stock, but I still own the stock. I'm still going to, let's say next year they start making a profit. Guess what? I still start getting ordinary dividends again from them. So it's not like I lost my investment in it. I just lost what's called my basis in that stock. I didn't really lose it. I had to decrease it.
Right.
So only when I run out of my basis in a stock, the amount that I invested in the stock, and they're still giving me more back, that's when I start having to actually pay taxes on it. And here's a problem, guys. I kind of want to stop there, and I'll tell you why. Because the next two sessions, we're going to get into depreciation. We're going to get into basis and depreciation actually next session. And I think I'm way deep into basis that we haven't even talked about right now. Okay.
Mm-hmm.
So I want to offer my apologies if I've confused anyone. So if I have, just accept right now that there are situations where you can get a non-dividend distribution, which means a distribution from the company's assets and goodwill that might or might not be taxable to you as the person receiving it. Okay, that's really all I need you to know at the second. And I need to look at something because we're several minutes over. I need to look at where I'm at. We're going to go a little bit longer unless somebody has to leave. We're going to go a little bit longer just to get a more convenient stopping point. But let's take a look at this. This is a 1099 div, a DIV. It has your ordinary dividends reported in box 1A, qualified dividends in box 1B. It has capital gain distributions. That's where they might actually have their own. They might have sold. Remember, I said a company can own property, like a business. Let's say a piece of machinery. Well, if they sell the machinery, that's a capital gain to them. If they sell it for a profit, that's a capital gain. They are going to distribute that gain to you or your portion of it. Non-dividend distributions are reported in box 3. That's really all I wanted you to see. Dividend income, payers of dividend income are required to issue a Form 1099-div or substitute payment statement if the dividend is equal to or greater than $10. This is the same rule as it was for the interest income. So just remember that if it's equal to or greater than $10, they have to give you a statement. If it's under $10, they don't have to. And you want to always report all dividend income on your 1040. So how does this carry through to the 1040? Ordinary dividends reported on the 1099 div in box 1A, that goes to the 1040 line 3B. If you have a 1040 in front of you, look at it. If you don't, look at it later, but you'll see where it goes. So ordinary dividends go on 3B because those are taxable. Qualified dividends that are shown in box 1B of the 1099, those are not taxable, so they're going to go on line 3A. Capital gain distributions. These are taxable to you in most cases. As a general rule, let's put it that way, and that's reported on box 2A, just like we showed. That goes on to it's a 1040, but it's the Schedule 1, line 13. By the way, do not remember these exact lines. I'm giving this to you so you can see how it all flows together. Just know it goes on the 1040. A non-dividend distribution is reported in box 3, and generally, that's not reported because it's a return of your capital, your initial investment. There are circumstances, like I said, if you run out of basis, which we haven't talked about, it might become taxable. But don't worry about that. Just know the general rule. Generally, it's not taxable. So when a taxpayer buys part of a company known as a share, the company may decide to pay an amount representing a portion of the company's profits or a return on investment. These payments are known as what?
Dividend.
A dividend. That's right. Perfect. Ordinary dividends are paid out of the blank of the corporation.
Earnings and profits.
Perfect. Earnings and profits. A common type of mutual fund is what?
Money market.
Excellent. Money market. That's right. When a mutual fund sells assets that were held for more than a year, the distribution to the taxpayer is known as what?
Capital gains distribution.
That's right. Capital gain distributions. The taxpayer may receive a non-dividend distribution, which is a distribution that is blank of a corporation.
Paid out of the capital contributions account. A.
Yeah, really the answer is B, but you're not 100% right. It's not really the reason it's wrong is because we kept talking about capital. It's not a capital contribution account. That's why that's wrong, but I know why you answered that way, because we were talking about if it's not out of earnings and profit, it's coming out of their capital, and that's correct. But it's not part of this is a unique kind of account. So that was kind of a trick question. It was not intended to be. Qualified dividends are what? Where are they reported?
Added to ordinary dividends.
C.
I know there was some confusion there, but that's because it's just you guys needing to get a little more familiar with the actual Form 1040. Remember, qualified dividends are found in which box of the 1099 div? Does anyone remember?
A.
2A.
2A, that's right, 2A. No, it's okay. It's just because you don't have the forms in front of you, and that's where this gets confusing, and I know that. By the way, for future reference, I'd really like it if everybody prints out a complete copy of the 1040 and schedules 1 through 5. Have it available for every session so you can refer to it. It'll help you. And then all you do is you would have taken that and you would have been able to see on line 3A, it says qualified dividends. You would have gotten that right. That's all. It's just you couldn't see the form, okay? We have not talked about Schedule B. Let me just check something here. I think I want to do Schedule B, and then we're going to stop and we'll talk about capital gains tax next week. Well, actually, we could look, guys. Let me ask you this: do you want another? Do you mind going for another 10 minutes to finish up this section? We're over about a half hour already.
Mm-hmm.
Are you on board for going another 10 minutes to finish this up?
10 is okay.
Okay, you guys okay? And I'm sorry about this. We do our best to time these right, but you know we can't always get these exactly right. So look, Schedule B. You already know where to report interest and dividends directly on the Form 1040. But there are circumstances where you have to report it first on an attachment called a Schedule B for interest and ordinary dividends. You must use a Schedule B when your taxable taxable income for interest is more than $1,500, or you're excluding U.S. savings bond interest, or the ordinary dividends are more than $1,500, or they have interest from a foreign account, or any of the other special situations apply, which I'm not going to have you guys worry about. These are the big ones. If you have interest or dividends totaling more than $1,500 from all of your sources, you need to use a Schedule B. You report it on there, and then you carry the total amounts from Schedule B to the Form 1040. Okay? That's the big ones I want you to remember. So $1,500, that's when you need to do it. For example, Benjamin has taxable interest of $800 and ordinary dividends of $770. Benjamin is not required to complete a Schedule B. Why? Because it's total interest of $1,500 or more, or total more than $1,500, or total dividends of $1,500 or more. It's not added together, right? Okay, so how do you do it? Well, there's your Schedule B. There's part 1 is for interest and part 2 is dividends. All you do is list all of the interest right here, add it together, and then you carry it to the Form 1040, line 2B. So all it is because there's more than $1,500 total, you got to list them out here, total it all here, and then put it on that line. That's all we're doing. And this is the one for dividends. Works the same way. You list all of your dividends, add it all together, and then put it on that line. And this is how it would look. There's the dividend one. 1099 dividend. This is a regular 1099 dividend, and this is an alternative statement for one. But notice it says the same thing, 1A, 1A, 1B, 1B, and so on. These are giving you the same information. It just looks, it's a different form. That's another different form. And this is a consolidated statement showing both interest and dividends on one page. But it has the same information. 1A, ordinary dividends, 1B, qualified dividends, and so on. And that's where, this is a Schedule B that's filled out. There's a brokerage house. Even though there's only one entry, the total amount for interest was more than $1,500, so they had to put it here, and then it carries through. And because they had to do Schedule B for this, they went ahead and put the dividends, even though it's under $1,500, on here, and then these amounts will just carry through to the 1040. So if Eileen's ordinary dividends are blank or less, she can report the total amount of ordinary dividends on blank. Which answer is correct?
C.
That's right, C. 1,500 or less, she can report it directly on the Form 1040. Weldon received $450 of interest income plus $1,200 of ordinary dividends from sources inside the U.S. for the tax year. Is Weldon required to file a Schedule B?
No.
No.
You guys are correct because it's under $1,500. Jasmine received $1,275 in interest from a bank account she maintains in England from when she attended college. She also received $150 of ordinary dividends from sources inside the U.S. Is she required to file a Schedule B?
Yes.
And why is that?
Foreign income.
Because of the foreign income. That's right. Jason and Marie received $1.49 interest on their tax account for the year. How much interest must be reported on their return?
$1.
That's right, Lisa, $1. Michelle received a 1099 interest statement reporting savings bond interest in box 3 of $10.14. How much must she report on her tax return?
$10.
$10, that's right. Good. And then capital gains. We've touched on this several times and kind of got a little deeper than I meant to into it. Capital gains. Any qualified dividends or capital gain distributions are taxed at the reduced capital rates of 0%, 15%, or 20%. We already talked about this. I showed it to you when we first saw it, and I said, guess what? These are capital gain rates. These are a good thing. So in real life, you want to use the qualified dividends and capital gain tax worksheet to calculate how much tax you'll pay on it. And you use that when the Schedule D is not filed. Don't worry about what Schedule D is right now, but you calculate it on Schedule D if you're using a Schedule D. If not, you use this worksheet. You want to calculate it, though, because it's actually going to calculate the capital gain. It's going to take the qualifying amounts and separate it from all your other income and say, okay, this is the amount you'd pay on that, and it adds it back in to your other income. And it's doing a comparison. How much would you pay just if you did not use capital gain rates? How much would you pay using capital gain rates? And whichever one ends up less, that's the one you give your client. And that's what the form does. We are not going to go through this form. I just want to show you what it does. okay? It would be good for you sometime to go through this form and play with it, but guess what? You don't need to go through this form to be able to really pass the exam. But the more you understand these things, the better it will help you down the road. So qualified dividends and capital gain distributions are taxed at the capital gain rates of, which rates are the correct ones?
A.
A.
That's right, A, 0, 15, and 20%. Which of the following qualify for reduced capital gain tax rates?
Qualified dividends.
Yep, you're right. That's right, Garrett. Qualified dividends are. And guys, that's it. So we got through that. Now, I want to take just a second. I know everyone's tired. I want to take just a second to give you a chance to ask any questions or make any comments, because we went through a rough patch there, and I'm always concerned when we run into those rough patches that I've confused someone. So does anyone have anything they want to ask or any comments they want to make about this? Okay. So far we have covered, we've done 3 live sessions, and we've covered reading in your chapters, in your passkey, the book that you've got. We've done chapters 1 through 5. So that's the catch up. Those that have not read that yet, that's what I need you to catch up on. We're going to spend the next 2 sessions, Fridays and Monday session, we're going to spend the next 2 sessions talking about these items, and I want to give you a heads up. Basis and depreciation, then capital gains and losses, and then some special considerations for depreciation. You should read in your chapters, you should read chapters 6 through 8 in preparation for that. It doesn't mean you have to get quite through everything, because we're not going to cover everything. We're going to take 2 sessions to cover all that. There's a lot there. Now, I want to talk to you and tell you why I'm jumping deep into this so early. The reason I am is you need to understand, as you can already see, we're stumbling over this basis thing because we haven't taught it yet. We need to teach this so we can talk a little bit about self-employment, so we can talk about distributions and owning a house and things like that. There are things we need to know from this to help you with later sessions. So we're going to spend 2 sessions talking about those things, and I'm going to ask you to prepare by reading chapters 6 through 8. Okay, so any questions about that?
No.
Okay, good enough. So who needs to talk with me after everyone else is done? We're done with this session. Who needs to talk with me after the session is done? And Ryan, by the way, can you hear me? If you can you start